All right. So we've got a very interesting discussion set for lunchtime, so we wanted to go ahead and use all the time we had available. I won't bother giving a long intro for either Nick Timros or Lou Ranieri, because they're both relatively well known to everybody in the room, I think, and to those who don't, I'm not sure what planet you've come down from, but you've got literature there to read the bios. But I will say a few things by way of sort of color and how I think about both Nick and Lou. One of the most frustrating things about this policy space to me has long been how such a complicated area has somehow fallen into such overly simple narratives. Folks tend to talk about the relatively complex, rich topic area that is housing finance in maddeningly simple terms often. Either the government's the market savior or it's the pariah. Either lending is all but cut off or we're heading off the next cliff of subprime. Sort of pick your narrative, but there's very little room for nuance or anything in between. So it's no wonder that the folks outside this room who depend on us to actually explain it to them can't make heads or tails over what's going on in the housing market, because many of those charged with explaining it tend to incline towards those sorts of narratives, which aren't all that illuminating. Luckily, neither of the folks up here fall into either of those traps. Nick has covered housing with the Wall Street Journal since the roof caved in on us back in 2009. His portfolio is broader now, but luckily he still covers it a bit. His pieces consistently convey the nuance and complexity that define the space, and as a result have long provided an anchor to reality for those of us debating the issues, and one of the rare windows on how to think about these issues for the general public. And Lou's sort of, as you guys know, part stakeholder, part public intellectual, part icon, part iconoclast, really impossible to pigeonhole very usefully. And perhaps for that reason, somehow free of many of the biases and simplifying frames that the rest of us get caught up in. So like Nick, he brings a perspective that's refreshingly free of the political blinders that plague so many of us. Thankfully, is likewise moored in reality, if not always politics, and always a bit surprising. So with that as a backdrop, I look forward to the conversation, and at the end we may open this up for questions depending on how much time we've got left. So with that, take it away, Nick.
Great. Well, thank you so much, Jim, for that great introduction. I will try to disappoint you at some point here with a less nuanced story. And thanks to Urban Institute and CoreLogic for hosting this event today, and thanks to Louis for taking time to partake in this discussion. I guess maybe to start off at a fairly broad level, Louis, if we go back 30 years to when securitization was, in its relative infancy, as you've told me before, there was a concern as a nation that we might not be able to house the baby boom generation, that there wasn't enough capital in the banking system to do it, and this maybe doesn't take into account the fact that the savings and loan industry was beginning to fail in large numbers. And so with that kind of frame, now it seems like maybe we're at another demographic turning point, right? The echo boom is coming of age. As some of the discussion this morning touched on, we see rents rising, we see home prices rising, despite relatively anemic home sales. And so my question to you is this, are we facing another sort of, oh my goodness, moment for the nation and for the housing policy community as we did 30, 35 years ago? And if so, what are we going to do about it?
Well, 35 years ago, it was more simplistic. We had a specialized industry that funded housing, whether it was savings and loans and a few banks, but that was the industry that funded housing, and the demographic demand of housing, in simple English, dwarfed the ability of those institutions to grow their balance sheet. Not because of the footings, but because the amount of equity that would have been required to carry those footings. And the cost of that equity made it impractical. So we were faced with, nobody remembers this, but we were faced with this issue of, oops, if somebody wants to buy a house, how are we going to be able to finance him? It was really that simple. It wasn't remarkably complicated. And the solution, for better or worse, turned out to be off balance sheet. It's developing securitization. In a sense, we have that same issue, although I think it gets bifurcated into two pieces. Part of it is the economy not creating jobs and income growth. So people who could afford a house, as a byproduct of the Great Recession, credit is very tight. So you have that. That's one part of this problem. It's a more simplistic problem because you have a portion of the population that can and should be able to afford a house is not getting access to it for various reasons. But the bigger one, which is more like the original one, is if you think about the millennial generation, I think there's 82 million born between 1980 and 2000, 82 million. And the real issue I see is not simply accommodating the demand, the number of bodies, but the fact that it's a very different demographic. All the economists in the room can tell me that I said this wrong, but my understanding is that within 10 years, 36% of the millennials will be 36% of the population will be minorities, and something like 46% of those 20 to 34-year-olds will be 50% of the first-time homebuyers. We've never had a demographic like that. When I first set out many decades ago to deal with the problem you mentioned, Nick, minorities were 20% of the population and a fraction of the first-time homebuyers. We've never built a system, much less the somewhat damaged system we have now, that could accommodate 36% of the population being minorities or 50% of the first-time homebuyers being a minority. We just have no such system. So so yes, we have an oh my moment because we have to solve two problems. One, the more difficult one to solve, can we build a system that houses these people, whether it be rental or home ownership? And two, because of rental, for the reasons that you heard the panel talk about, we don't have the units, and the units are building them in the right place and not going over 50% of income is a challenge. And the other, for the housing, we just don't have that system in place. So how do we solve it? We have to start to address the problem in pieces. I mean, what happens, by the way, outside of this room, outside of this industry, America is blissfully unaware of this. They don't realize that, we're rapidly running to a crisis in less than 10 years. This is not Social Security. This issue will be upon us in less than 10 years. So all of us will still be around, hopefully gainfully employed. Maybe I'll have enough brains to finally retire before then. But, it is something we have to deal with. We can't just keep pushing it off and maybe it will go away. And again, the part that's the economy not creating jobs or not income growth is something beyond my kin. But the part that says for those where that is not the issue, it's the unavailability of credit, that we can solve, that we can deal with in various ways. But unless we elevate this to a national priority, nothing's going to happen. And in my mind, that's the greatest problem. That we talk about it ourselves. We usually talk about it in little silos, and we can't solve it that way.
So I want to break that apart a little bit. So the supply of credit's an issue. It sounds like also the supply of, in terms of what's being built, is also an issue. How do we tackle the first of those, the credit supply? And as somebody who's an investor in private mortgage markets, to the extent that they still exist, how do you look at this space? Where are you willing to where are private investors willing to put money right now and why, and where are they not willing to put money and why not?
Well, you're asking multiple questions.
Sorry.
The lack of credit is a holdover from the Great Recession or whatever word you want, right? The system is very reluctant to go beyond a certain point in making a loan. We call it credit overlays. And the overlays come from a series of concerns, putbacks, litigation, reputational risk, on and on and on. So it isn't that the agency box isn't big enough, it's that nobody exists on the length of the agency box. They're all operating in here. And as a result, many less people get credit who would normally have gotten credit. I mean, the FICO score for the agencies has been bouncing in the mid-700s, okay, for a long time now. And so part of that solution is to just, in effect, start to cut away the issues that make people reluctant to lend within the normal definition of prudent underwriting. This is not by way of making dopey loans. It's just by way of removing the concern that keeps everybody bunched up in the middle of the box, nowhere near the limits of the box. Okay, that's one issue that can be tackled. In terms of where people in the mortgage market has evolved. There's all kinds of things to invest in the mortgage market that most people don't even know exists. I mean, think about it. In the last panel, they were talking about some of the bonds created to sell off risk from the agency securities. That is $300 billion worth of reference bonds. That was over $10 billion worth of real money so far. I mean, that's a whole new market that never existed, and it's growing exponentially as the agencies continue to try and, in effect, be second loss instead of being first loss. The movement of servicing MSRs out of banks to the private sector was growing dramatically till the agencies slowed it down, trying to making sure they had put capital requirements on the non-bank servicers. But those capital requirements are coming forward, and that market will pick up again. That's many, many, many billions of dollars of servicing that will transfer over the next 18 months. The private label securities market is really tiny at this point. This year, I think we're about $6 billion. Last year we did 13. We're doing only, maybe we'll hit 10 this year. But the real issue about that, and it's one of the things we did not talk about. You know, wherever Jim went, he's always harassing me to give him answers. And the honest answer is, if he asked me now, can we shrink the agencies because we can take that credit and have the private label market, the RMBS market, handle it? The answer is absolutely not. The private label market cannot handle the volume. You know, it can do more than $6 billion, and if it had the volume, but it can't do $50 billion or $100 billion. That market is crippled, and we're in the process of trying to remediate the issues that would give it a rebirth, but it isn't there now. It's a whole discussion in and of itself. But before we can worry about getting less agencies, we have to have some place with the loans. Loans have to go someplace. And there's an old adage. I'm sorry, I didn't mean to carry on. There's an old adage: if you can't get a bid, you don't have a market. Well, in the whole loan market, most often, except for a small PLS market, it's the banks. But what we all have to remember is these are 30-year loans. These are not exactly bank assets. One day the regulators will wake up and say, oh, gee, I think I went to this movie once before. So we should not be counting on the banks to fund the 30-year mortgage market, right? So, we have to try and deal with these issues, and we can.
So why is...
Was that a coherent answer?
No, it was very coherent. So the reason that the private label mortgage-backed securities market is dead, is it oversimplifying it to say that simply trust has been shattered, and until you repair, whether it's servicing, second liens, reporting requirements, reps and warranties, you could probably give a more thorough list. But is it an oversimplification to say investors just don't trust this market still?
Yes, the biggest issue is trust. There are a whole bunch of technical issues, okay? But you can wrap them all up in the word trust. I'll give you the simplest example. There are 5 consistent issuers of PLS, and somebody will raise their hand and say, no, 6. Okay, whatever you want. There's not a lot. But even in that small group, there's no consistency of rep and warranty. Everybody does it their own way. So if I'm a buyer and reps and warranties are very, very near and dear to the investor's heart, I have to read through 1,000 pages to look at the difference from one issuer to another. Nobody's going to do this again. I'll give you the biggest of all 800-pound gorillas in the room. I last week spoke to the AMI, which is the group of investors in PLS or RMBS, whatever you want to call it. And I asked that group, and we had almost everybody in the room. And I said, guys, if we weren't issuing super clean paper, how many of you guys would still buy? Less than half raised their hand. They're willing to, in effect, deal with all these vagaries that have not yet been solved because the paper's so clean. But to give you the 800-pound gorilla, every time you read in the paper about some bank doing a settlement with some government agency for $1 billion, and the bank pays $150 million, and the investors put out $850 million, they go, the hell with this. I didn't create the problems. How come I'm paying 3/4 of the loss? Those aren't my losses. So when you say trust, that's the uber issue. Until you can allocate the losses to the people who created them so that the investor isn't always taking the short end of the stick, you can't have that market.
And are we making any progress there?
No, not yet. Dodd-Frank was a real step forward, and the result of the Dodd-Frank rules are RMBS 2.0. That's the securities we're issuing now are RMBS 2.0. And the Dodd-Frank rule moved it forward because you have, the underwriting rules. You can't do 228s or 327s or negams or, all the other terrible stuff that people invented. And there are processes now, regulations in terms of rep and warrant relief and stuff like that, but it's not really what it really needs to be. So the industry is now working on RMBS 3.0, and the magic of RMBS 3.0 is for the first time everybody is involved. There's as many investors as there are bankers, as there are lawyers, as there are Wall Street firms. So in the workings of RMBS 3.0, all those working groups are everybody working together to try and find solutions. But it's probably going to take 3 years. But that doesn't mean that you can't bring solutions on one at a time as they come on. But it isn't going to give you an immediate panacea. You take the biggest issues first, and then as you go forward, and the common securitization platform will in and of itself drive some things that will be a standard, because I would remind all of you in this room, the agencies were before mortgage trades. Mortgages didn't trade. Banks made them and put them in their portfolio. So Fannie and Freddie were before, and Ginnie Mae, Ted Tosher will be angry at me if I didn't mention that, were before. And when we started dealing with mortgages that were not being given to the agency, we always said agency docs, agency standard, agency underwriting. We used the rules the agencies had created as the benchmark on which to make the others. Right? So the agencies, one of the things the agencies did was not just guarantee everything, they set the standards for everything. So, my friend sitting directly in front of me has started that machine forward again in terms of the common securities platform will be, again, a benchmark which will hopefully help everything else in the process.
So last week or 2 weeks ago, Mel Watt at the FHFA announced new possible framework for reps and warrants. We're going to see the GSEs roll out in the next few weeks, maybe a new 97 program. We saw the QRM rule finalized, and it all kind of got stitched together in this narrative that the government is going back to, The Economist had a headline that said America is going back to the easy credit that fueled the boom. And I'd be interested, first, whether you think that's a legitimate worry here, or is Washington so desperate to get housing going again that are we making some of the same mistakes again?
Not insofar what people have said. First of all, I don't mean to bore you, but I think it's important. Fannie and Freddie are not the Fannie and Freddie you used to know. Okay, there's been a tremendous amount of work done by the agencies and FHFA in terms of process, procedures, systems, whatever. So take what you just said, a 97% loan to value. Well, the first issue is it better be, if you're going to make 97s, you better be sure about what the appraisal is. You better be sure that you really have 3% equity and not negative 3% equity. The number of you in this room who know that the agencies, both Fannie and Freddie, have a common portal. If you're making an agency loan, you have to put it through you put it into a single place, okay? And they have very sophisticated systems and algorithms which therefore look at that loan and what's being used as a comparable versus everything else that could be used as a comparable to pick up anomalies. Plus, it scrapes data to find problems. It's not a perfect system, but it's a very, very, very sophisticated system. So just because they're going to make a 97, which, by the way, I don't think they're going to make very many others because they're not giving up on the normal reps and warranties. They're not giving up on all the other normal rules. So I think the number of 97s is sort of tiny. But before you think that, here we go, 2006 and 7, you have to look at what the modern agencies have in terms of their ability to protect themselves, whether it's appraisal or reps and warranties or servicing errors. I mean, I could give you a whole litany of what happens now in terms of dealing with an agency and putting a loan through. Mora is a system which basically analyzes and monitors how well servicers service and how much capital they have and whatever. There's just like this whole list. So, no, I don't think that what Mel or others are trying to do at this point is a risk to the system, okay? I think what they're trying to do, especially, I told you, I think 97s are more political than they're practical. I mean, I think the issue of trying to do rep and warranty relief and some of those others are real because what they're trying to do is get the overlays not out of the system because those reliefs won't make everybody comfortable, but they should make some people more comfortable, and the box, instead of that big, will start to be this big, okay? But what Mel Watt can't do is control the SEC, the Department of Justice, the CFPB, and everybody, and 40 states' attorney generals. I mean, part of the issue is as long as you keep suing everybody, everybody gets nervous. So you can do what you can do, but there's a lot of pieces to that issue of why overlays are overlays. I'll give you a simple example. The CFPB is considering merging RESPA with TILA. Well, those of you who know, those two rules have very, very, very different penalties. And one of them is, exponentially worse than the other and also allows for class action lawsuits. So everybody's going, oh, my goodness, now what? What does that mean to me? I'm not trying to do anything evil, but if I make a mistake, I don't want my head on the wall. And can I afford to take these additional risks? Every time you play with the machine in a period where everybody's nervous anyway, people get more nervous.
Well, it's interesting, too, because on the other side, you have some people who say there hasn't been enough retribution. We'd like to see more heads on the wall, right?
I'm perfectly happy to go kill the guilty. I mean, the question, that's okay by me, all right? But in the process of hunting for the guilty, at some point, you can't throw a net so wide that you capture everybody, including the innocent. And if you want a market that's not all government, you need the investors, the bondholders, okay, who just simply say, hey, wait a minute. All I did was buy this stuff.
Yeah. The reason I asked that question about are we going back to kind of a dangerous mindset, even if it isn't, say, in the next year or two, that, well, there will be a time maybe when prices are going better, people will forget, we may end up making the same mistakes down the road. The reason I raise that is that you often hear, after that point is made, the question, well, look at the home ownership rate. It's it's back to where it was 20 years ago. So for all of the mortgage interest reduction, for all of the GSE support we've done, over the last 20 years, we've had all these subsidies go into housing, and the home ownership rate is no higher than it was 20 years ago. Isn't it time to stop promoting home ownership? Is that a fair criticism of our nation's housing policy?
No, because I would tell you that prior to that, whatever it is, 7-year period where the world blew up, where everybody went mad, and that's the only way I can describe what happened, because and it wasn't no one knew. I mean, many people were complaining, many people were giving speeches and talking about what was going on, but nobody did anything. But the system, this has been going on for 40 some odd years. I wouldn't take 7 years and basically abandon, and you heard one of the speakers talk about how much of a difference home ownership has meant to generations in the past, and how much it means both economically and emotionally to the Hispanic community. But I also need to say this, since you always like to get me in trouble anyway, okay?
That's my job.
People have this view that the affordable housing goals were what blew up the world. That's just not true at all. The agencies never had enough affordable housing paper that they made themselves under their rules to make much of anything. I mean, that's provable. I mean, it's just raw data. So yet somebody called it the urban legend. We continue to operate under this urban legend that trying to put moderate income and low income people in the houses blew up the world, literally the world, because the Great Recession went well beyond the United States. That's not true. That's not what did it, okay? It wasn't. First of all, how do I describe this?
You couldn't get income credit for a liar's loan if somebody was inflating their income.
Well, no, think about it. What happens? The agencies grow, the private label market starts, it becomes more complicated, the structures become more complicated, and nobody steps in and starts to say, hey, wait a minute, guys, making a balloon loan to a poor family is not a brilliant idea. They have less financial resources to handle it, and they have less financial sophistication. But that was always true. We've made loans to poor people through FHA and through banks under CRA for 45 years. We knew that those structures made no sense. People said they made no sense. But not only did they make them, they securitized them and sold tens of billions of them. Oh, looky, it blew up. Of course it blew up. It made no sense, to start with. So housing does do what it was supposed to do. We just have to. And a lot of we no longer can do a lot of the things we were done in that period. And no, most of the people who in fact led that charge have not personally paid for it, and I understand that. That's an issue, right? But I wouldn't shut the machine down because of what happened in that period, and I certainly wouldn't blame. The RMBS market got bigger than Fannie, Freddie, and FHA altogether. Do you realize that? The RMBS market became bigger than all the agencies put together. And it got bigger based on all of this crazy stuff, on Alt-A loans that nobody ever was willing to do, on a definition of subprime which was not anybody's historical definition of subprime. So, of course, it became exactly what it was likely to become.
So, and you touched on this in the beginning. When we talk about lending to folks with lower incomes, the HMDA data has shown that, so you know where I'm going, the number of loans made, I think, in 2013, in absolute terms, not even in percentage terms, fell for low-income households. And one of the issues that has been hard for me to square, frankly, you talked about incomes, weak incomes versus tight credit, and it seems as if that's an important dilemma or question to get right, because if you think the problem is primarily that credit is too tight, you should ease credit. But if you think the problem is primarily that we're simply not growing incomes, and so, all the credit loosening in the world may not be able to help much, how much of it is one versus the other right now?
There's no magic bullet. I mean, it's both at this point. On one hand, you don't have income growth, right? On the other hand, those who do have income to support a loan aren't getting it anyway. I'll give you the classic number, the one I love to use because it's so strange that nobody believes me. But in the 13 HMDA data, and guys, don't shoot me. I mean, I'll be pretty close. Out of 1.6 million conventional purchase loans made, how many loans were made to African Americans? 39,000. Hispanics, about 88,000. I may be off 1,000 more or less, but those are the numbers. Nick, do you really believe that there were only 38,000 blacks who could afford a house, or 88,000 Hispanics? We created a system that, in effect, financed upper middle income white guys. That's the only conclusion you can draw from that. Now, it's somewhat better, but it's not a ton better. I don't think the 14 HMDA data is going to be dramatically different than the 13. And 13 was actually worse than 12. I mean, so, part of it is income growth. But it would be nice to at least finance the people who could finance, who could be allowed to finance.
So we can't completely write it off because say, oh, well, it's just because incomes are weak.
No, there are many qualified people, and if the low-income advocates were in the room can certainly tell you that for decades we made loans to people with FICO scores of 680, 660. If all the other ratios were there, I mean, it's because it's not just a FICO score, right? It's lots of parts that go into the underwriting. They're good loans. In fact, Fannie and Freddie made loans as low as 640 given all of the data they had, and very few people have all the reference data that the agencies have. So, why now is such a small, if your FICO is under 700, you have a hard time getting a loan.
Right, unless you go to FHA.
And then the reality is, if you look at the points and fees, it's harder. I mean, part of the reason people say that it's easing is because it looks like Fannie and Freddie are doing more volume. Well, the reason they're doing more volume is because the points and fees on FHA are driving the volume back to Fannie and Freddie. But if you put them all back in one box and divide, you wind up with the same FICO scores. It doesn't really work that way.
Yeah. I want to...
Sorry.
No. I want to move to audience Q&A in a minute. So think of a question. But before that, so the picture you paint isn't the most optimistic one about the state of the mortgage market right now. It sounds fairly broken. And yet, I think as we heard this morning, you look ahead legislatively, it doesn't seem like very much is going to happen here with GSE reform. It's a complex issue. I don't know, maybe you disagree. Maybe you think Congress and the White House are going to have a come-to-Jesus moment here, but it doesn't look like it. So what do you do administratively if you're, in this administration? do you try to solve the GSE problem, or is that just, you put that on the back burner right now because it'll get in the way of fixing these other issues?
Well, first of all, let's assume there's no legislation, and I haven't given up hope. I mean, we've come a long way. Theoretically, if the Republicans and the White House are prepared, I think you could do a deal. I certainly hope that's what happens, because so much work has been laid down that could lead to a deal. But what seems to me is that everybody forgets how much authority the agencies have over themselves. FHFA has, the HUD secretary has. As an example, if you want to have less agency, more government, just lower the loan limits. I mean, you don't need anybody to lower the loan limits. Just go lower the loan limits. The head of FHFA can lower the loan limits. I told you the PLS market can't handle a lot of volume, but it certainly could handle another $20 billion or something. I mean, in other words, you could start to move in that direction. The FHFA is gingerly starting to try and deal with the overlay issues. There's a lot they can actually deal with. The fact that they're going slow and trying to do it carefully is the right thing to do. But in 2 years, just with the authority that the agencies have, and Treasury has a lot of things they can actually intervene on if they so choose. And so I wouldn't say bill, no bill, and if there is no bill, we're just going to sort of wander around in limbo for 3 years.
Well, I guess what I should have asked was what are the risks of not doing anything right now, specific to the GSE issue? If there are.
All right, you can't resist getting me in trouble. Okay.
I cannot.
One of the real risks, and this is like nobody we talk, so I'm sure the guys at Freddie are about to kill me, but listen, when we talk about the common securitization platform, why do I and others push so hard to get the common securitization platform done so quickly, not 4 years from now or 3 years from now? Well, in the first instance, it costs the taxpayer money. I mean, the way Freddie gets volume is they subsidize the rate. That's money out of the taxpayer into the hands of the arbitrageurs in Wall Street, because they basically take the Freddies and put them in CMOs and make the spread, right? Which in effect is a circular problem, because then you have less Freddie liquidity, which is why Freddie trades at a discount, although it has, on a net present value, a higher value because of the pay date, right? So, but every day, I used to work in a institution, and we used to tell the inmates every day in every way you're getting better and better. Well, the fact is, every day in every way, Fannie becomes the stronger and stronger partner. At some point, especially if rates went up significantly, Freddie might have to go back to the Treasury. Now, they'll all yell at me, but most people know that's a realistic possibility. If Freddie had to go to the Treasury, you'd have emergency legislation. There has never been such a thing as a good emergency legislation. So I would much rather have the common securitization platform, which solves many problems quickly, rather than 3 or 4 years.
With a single security.
Yeah. But it doesn't. I'm not suggesting you don't have Fannie and Freddie. Because the common securitization platform makes no decision about who's putting loans into it. In fact, it was designed to have multiple. For my purposes, it's fine by me to have a Fannie and a Freddie. Okay, I just don't think it can leave the status quo. I think one of the risks of the status quo is, in effect, Fannie becomes a monopoly. And I don't want another monopoly with the power of the sovereign. And I know that's a radical statement, but you've been trying to get me to say something you can get me in trouble with. So I just gave it to you.
Thanks, Louis. Since my mission is accomplished, I'll let you guys take your turn. Bert, maybe if we have microphones, the microphone's going to come to you. If you could state your name, your affiliation, and then ask a quick question so we can try to get in a couple questions. Thank you.
Thank you. Bert Ely, banking consultant. Lou, great to hear your remarks today. Covered bonds have been used for housing finance for a long, long time in Europe. They've spread more and more to the Anglo-Saxon countries, Canada, having recently enacted covered bond legislation. Given the nature of the American home mortgage, do you see a potential role for covered bonds as an element of housing finance in this country? And more specifically, would you support legislation that would create a covered bond statute that would provide uniform rules for covered bonds, such as Scott Garrett has introduced?
Yeah, so yes, but let me give you the caveat. The problem with a covered bond is it's basically a drawer on the balance sheet of the institution. A covered bond has the right of substitution. So the reason you'd rather sell things is because, in effect, if you do a covered bond, if I were a AAA bank, I wouldn't want a covered bond. I'd just rather issue unsecured debt and keep all the assets, okay? So, and the other limitation of a covered bond is they're generally not 30-year covered bonds. So if you had 15-year loans, you could do covered bonds easily. I think given the credit quality of a lot of the banks, it's probably a good idea because it would be for many of them a lower cost of borrowing. So it would have a place in the quiver, in the arsenal, but it's not a panacea, especially for the 30-year loan.
And would it advantage larger institutions, or would smaller institutions have?
It works for smaller institutions. They're insured. It works for anybody, and it brings up this whole issue of the sacred cow, the 30-year versus the 15-year. You know, there's that structure that we're looking at. Remember that 15-year mortgage structure that you guys are talking about, which I think is very, very interesting, which would also, in many ways, mitigate the need to have to use 30.
One more question, if there is one. Over here, Jim. Wait for the mic so everybody can hear you.
Uh-oh, Jimmy.
So given what happened last night, what advice would you have for Republican leadership in Congress, and do you see any opportunity legislatively for movement on things that you think would be of use?
Absolutely, because as Jim well knows, I'm a Republican. But the fact is, the Republicans, this is a real issue. Housing is not make-believe. You know, housing is, after all, shelter, whether it's single-family home ownership, single-family rental, or straight, old-fashioned multifamily, okay? It's a real issue, and helping solve it, and most of the groundwork is laid for a solution. Jim, would you disagree with that? There's much of the groundwork is done. This would not be a Herculean task if everybody would be willing to, in effect, negotiate, which means not everybody wins and not everybody loses, to get a bill. So I would tell you very strongly, and I would tell my friends in both the House and the Senate, that it would be a great public service. And I thought that was why we sent them there in the first place.
Do we have time for one more? Yeah, we'll do one more.
Hi, Jim Vittorello with GAO. Good to see you again, Mr. Ranieri.
Right.
Your remark about trust sparked a memory trigger in my old mind about the many interviews we had with investors and trustees about the very lack of trust that the investors had in the trustees of these RMBSs, and specifically the fact that they have no fiduciary duty to protect the investors, unlike we were told, corporate bonds?
Absolutely.
1939 Act that required trustees to be have fiduciary responsibilities to the investors. That's not the case in RMBS, and I was frankly surprised to hear that. I'm sure you know that's the case. So the question then is, what if these trustees in future RMBSs were given the same fiduciary responsibility as they do in corporate bonds, nothing terribly radical here, I think, so that they could be the eyes and ears for the investors? You think that would work? Yeah,
what's happening in RMBS 3.0 is one of these stated objectives. There's a whole group that's just looking at, trust trustee rules and requirements and all those other issues. What it is attempting to do is that make every action in a security has to have someone who's responsible and capable of acting and being paid to act. But I will tell you, and I did this last week at the AMI, I said, look, guys, I've been doing this since the first security was ever created, all right? And we never really wanted to give away our power to the bondholders themselves because we didn't know whether we could trust them, not to be unreasonable. I said, I surrender. It's taken me 42 years, but I surrender. We have tried so many times in so many ways to fix this, but not let the bondholders, like in a corporate bond, be able to have a vote, that I surrender. One of the things we have to do in RMBS 3.0 is an appropriate role for the bondholders and their ability to have transparency and the ability to intervene in their own behalf. Remember, they didn't get paid enough money to do anything. They were more than happy to keep a limited role, except you and I know that's not what the word meant. But when you looked at the documents everybody signed, they didn't right. If we have to create a new trust, not word trust, big T, trust, the legal entity trust, and that trust entity has multiple functions. It's not just one, because somebody's got to look for early payment defaults and was there a breach, right? Because part of it is early breaches as well. I'm sorry I'm getting into too much detail. But we need a new trust, big T form, and somebody's got to be responsible for each of those actions and have the ability to, in effect, intervene to solve it or litigate it, whether it's arbitration or whatever. I can get you. There's been that's one of the areas in which has been well vented in RMBS 3.0.
Louis, thank you so much. Thanks to the audience for your participation. Are we staying here? Are we going into the next panel? I think we're going to go straight in to the next panel. So I'll invite the next panel up, and thank you very much.
Where do you guys live?
So thank you. Thank you. That was an excellent discussion. And I think it set us up nicely to talk about the government-sponsored enterprises and what can be done without legislation. When we pulled this panel together, it was such fun hosting the moderating call because I couldn't get a word in edgewise. So I hope it's the same. We have 4 really great people on this panel, all really experts in their fields and have a diversity of views. And we thought we'd start with Andrew Davidson, Andy, who's the president of Andy Davidson & Co. And Andy's going to talk a little bit about the need for capital in the system in the current state and how we get from the current state to go forward. Kind of what does that model look like? And then we'll go down the line. But I'd like to start first with Andy.
Thank you. Thank you very much to CoreLogic and to Urban Institute for having us here today. I think it's, this panel I think is a really good one. There's so many discussions we have about like what should be the future state of the world, and I'm sure we have as many different proposals for that as we have people in the room, or maybe everyone has 2 or 3 of their own proposals. I know I have a few, but what we want to talk about today is what can be done now. And I think if we look at Corker Warner, Johnson Crapo, we see that there is sort of an outline of an approach that seems to be developing, which is that there should be private capital bearing the first risk, and there should be some sort of government wrap that keeps the system stable, keeps the TBA market and the mortgage market functioning, that there shouldn't be a retained portfolio as part of the GSEs, or at least shouldn't be financed with government-backed debt, and that there should be a securitization utility so we can bring in some more players. And so what I think is a good step now would be for FHFA to start having the GSEs run themselves as if that were true or that were the direction that we were heading in. And so in order to do that, we split out these, you would segregate functions. You'd establish capital requirements for each of those functions, and then you'd implement a transfer pricing system, which is, basically what any large financial institution would do when they were managing these types of disparate activities. So the way I think through the functions is, one is that there's a loan insurance business, and that's, when there's a default on a loan that the Fannie or Freddie make good on that loss. They also have a bond insurance business, which is wrapping those. And the bond insurance business is sort of like the Ginnie Mae business. You take loans that are already guaranteed, and you wrap them and you put in a security, and there's an additional layer of guarantee there. That's really what creates the liquidity in the securities. Then there's securitization services, what we're calling, what will go into a common securitization platform eventually. Then there's the retained portfolio, which is the loans or mortgage-backed securities that are still on the balance sheet of Fannie and Freddie. And then finally, there's the multifamily business. So what I've done on a chart, which I think I can pull up here, is I've sort of very quickly said, okay, well, if we took the current combined balance sheet of Fannie and Freddie and sort of said, let's split it into those activities, what would be the capital charge? What would be the required amount of income associated with that? What are some of the other expenses that would be transfer price, like operating expenses or securitization services? And then finally, how much money has to go to whoever's providing the bond wrap, which Fannie and Freddie might say they're wrapping, but they're not really wrapping. The wrap has always been provided by the federal government through an implied guarantee, and now through the additional support provided by Treasury. And so what I just laid out here is, well, you take the roughly $5 trillion worth of loans that they're guaranteeing, and I said if you have 4% capital on that, that's roughly $200 billion worth of capital. So that just gets you start thinking about, well, if you were going to have private capital in the system, this is about how much you need. Maybe someone thinks that it should be 10%, maybe someone thinks it should be 2%, but it starts to say what kind of capital is needed. And then go on and say, well, how much money should be paid for the wrap, et cetera. So I don't want to go through all the numbers here because, like I said, they were really just sort of ballpark guesses, but it's really the kind of framework that I think would be useful. And if you had that framework, I think it would help with several different issues. One is, how do you price G fees? So what should be the competitive guarantee fee? Should there be cross-subsidization or not cross-subsidization? That comes through this. We could also develop risk sharing and better analyze the risk sharing. It's been mentioned earlier, there's now $10 billion worth of new capital that's come into the mortgage market through the Stacker and Cass transaction. So that's 10 out of the 188. It's a start, but clearly more is needed. But the question is, if you bring that $10 billion in, is that a one-for-one reduction, or is it more than one-for-one? So you really need a framework for making that decision. Doing this would also allow better evaluation of structural alternatives, like, is the common securitization platform really better? What are the costs associated with that? How much capital does that entity need as it gets set up? Decisions of that sort. Where should multifamily fit in? How much capital does that require? And then finally, I think this could provide a roadmap for legislation. I just don't think Congress is set up to provide a mechanism for saying what capital requirements should be for these entities. And if there was a framework in place, I think it would be very helpful to them. Thank you.
Thanks, Andy. That's great. Jim, given your position with the NAC prior to your current role and your help with the Urban Institute on keeping the discourse positive and moving forward, maybe we should ask you the question you asked Lou Ranieri, given last night. Where are we today? Where can we go relative to the current state?
So thanks, Faith, and thank you guys for coming. I think it's worth taking a step back and taking a bit of stock in what we learned in the Johnson-Crapo debates of the last summer. Not because I'm wildly optimistic that we're going to pick up where we left off come January, but I think it shouldn't be underestimated the value of having brought together a broad range of stakeholders
the administration, a pretty wide range of members of Congress in both parties to really wade into these weeds over an extended period of time. It's rare to get that level of attention across such a broad range of relevant thinkers on this. So it's worth asking sort of what comes out of that or what came out of it. And I think, and it should inform how we think about, I think, administrative reform, among other things. So I took sort of 3 lessons away from the Johnson-Crapo debate. The first is it's not going to be easy to do legislation. It's so complex politically and substantively, and Congress these days has such a hard time managing complexity of either sort that we need to begin to think about administrative reform, not in year increments, but possibly in increments that will extend well beyond that. We'll likely know, I would guess, as I think Lazio and Gene pointed out, we'll probably know early in next year whether or not we have any shot at all legislatively. But my sense is we should be well prepared to think in administrative terms for probably years to come, I think. So think of a longer time horizon for the reforms that we're talking about up here. The second lesson I took away from it, which is a little more optimistic, is I think there are some pretty broad areas of consensus, not uniform agreement, but pretty broad consensus. The first area of consensus, I think, is that we should do what we can to try to preserve broad access to long-term fixed-rate lending. Typically, I think of this in terms of a 30-year fixed-rate loan, but it doesn't have to be. And I think there's a broad recognition that to get there, you need an explicit government guarantee behind a significant part of the system. The second area of consensus, I think, was that the government is probably better positioned to manage certain parts of the housing finance structure, and the private sector probably a bit better to handle others. In the former category, I'd put securitization, the process of securitization, and maintaining or bearing catastrophic risk. And then in the latter, that is in the private sector's bucket, I put, as Andy put it, maintaining first loss risk. It feels like that's sort of where we were landing as an area of consensus. And then the third lesson I took away from Johnson-Crapo is that despite all those areas of consensus, we've got a ways to go in some other areas. I think, as someone alluded to in one of the earlier panels, we really stumbled a bit on figuring out the best way to ensure that communities that had been traditionally underserved in the market would have adequate assurance that they would have adequate access to a new system going forward. I think similarly we stumbled a bit with ensuring that small lenders would have access to the system in a way that would give them access that would allow them to compete with the big guys on at least close to equal footing. So I think it feels like we've got some learning left to do on that. So what I take away from those lessons is in thinking about administrative reform, we would be smart to do 2 things. One, advance the ball where we can in those areas where we've actually got consensus. We don't have to wait on legislation to begin to move, I think. And then secondly, do what we can to learn more in those areas where we've still got some homework to do, I think, in building consensus. On the what to do to advance the ball in areas where we seem to agree more or less, my sense is at the core of this, and Andy sort of gets at this a little bit, and I think Jim will as well, is disaggregating the functions of the current system a bit in a way that will allow us to transition to a system in which the functions, as between the government and the private sector, are allocated more according to what we sort of agree the system should look like going forward. And so the 2 examples, the way in which Director Watts sort of already doing this at FHFA, which I think are instructive, is the move towards a single security, which Lou talked about, which I think will have 2 effects, one of which affects long-term reform. But the first is, as Lou mentioned, Fannie really has a remarkable dominance of the market right now in virtue of their liquidity advantage. A move towards a single security will take that advantage away and force them to compete a bit more on price and access to credit, service to lenders and the like, which is good for competition, I think. But secondly, and more relevant to long-term reform, it'll finally disaggregate the guaranteeing function from the securitization function, which I think is something which will put us in a better position to move towards a system that makes a bit more sense going forward. The second step that Mel and company have been taking at FHFA, which fits a bit with that first one, is moving more aggressively on risk sharing at Fannie and Freddie, especially to the degree that risk sharing increasingly involves more sharing of first loss risk rather than mezzanine and second loss risk. You could imagine a world in which if we go more aggressively down that path, Fannie and Freddie will gradually, at least for certain pools, shift into more of a reinsurer role rather than a first loss risk taker role. So if you think of those two steps together and you fast forward 3-4 years down the road, what you've done, if we move down those two paths aggressively, is you've disaggregated in the current system the securitization function from the guaranteeing function, and then you've disaggregated within the guaranteeing function the first loss from the catastrophic loss function. And that really does put us in position, I think, to transition to a world that looks a lot more like where we were landing consensus-wise. And what Andy's suggesting on thinking about the holding of capital against different parts of the system would actually help a lot, because to the degree we're ever going to break the system up and make it more rational going forward, we need to better understand how to value the components of the system that will eventually go into the private market, how to price the parts of the system that are going to stay in the public part of the market. And then lastly, and I'll just put this as a placeholder, I do think that at the end of the day we're going to have to come back to Capitol Hill and knock on the door again to at least close the deal on reform. I think that if we take these administrative steps and move relatively coherently and aggressively, the need to move on legislative reform isn't as imminent as long as we're going to move on these steps aggressively and coherently and in not a hodgepodge sort of way. But to get from the system that we're in now, even an administratively reformed system, to one that has the stability and security of an explicitly guaranteed system that I think most of us want, and we're going to have to go back to Congress for a bit of statutory help, I think. But there's a lot one can do in the meantime.
Thank you. Excellent. Jim Milstein, welcome, and we're so pleased to have you on the panel today. And we know you have maybe a divergent view here, so I'd love to hear it.
Well, I actually saw Jim kind of inching towards me, so which is good.
Do you know, have to go forward twice.
Yeah. So just
there we go.
So while I think
Thanks.
the process that Jim at the NEC and that my former colleagues at the Treasury Department and those on Capitol Hill engaged in over the last 6 years to try to talk about a massive new legislative reform of the housing finance system, I think they forgot something along the way, which was in 2008, a Democratic Congress passed a major housing finance reform bill. It was called HERA. It created a new prudential regulator for Fannie and Freddie. It created a resolution regime for Fannie and Freddie and based on FIREA's capital requirements, and therefore created for the first time a very disciplined or potentially a very disciplined regime for capital regulation of the two enterprises as well as of the Federal Home Loan Banks. But a funny thing happened on the way from a democratically controlled Congress to a democratically controlled presidency. The Obama administration adopted the minority report of the Financial Crisis Inquiry Commission, that the Fannie and Freddie were really the true villains of the crisis, that it wasn't the RMBS market that Louis was talking about earlier and bad behavior in the bank market. It was really Fannie and Freddie, and they had the Treasury Department concluded to be liquidated, wound down in the language of the White House. And so they took out a whiteboard and decided they were going to recreate the second largest securities market in the world from whole cloth, with thinking that somehow that kind of grand Hoover Dam-like building effort wasn't going to create massive instability in one of the most important asset markets for ordinary Americans, called homes. And so my part of this debate over the last couple of years since I got out of the administration has been to say, hey, we passed, a Democratic Congress passed a housing reform bill. Not only did they pass a housing reform bill, but they funded it. It has hundreds of billions of dollars of funding authority, which the administration, following the Paulson Treasury Department, decided to use to put handcuffs on Fannie and Freddie rather than to use it to recapitalize the system, which is what, in fact, HERA contemplated. A better capitalized housing finance system, better regulated with a real prudential regulator with the authority to liquidate or put into conservatorship the two enterprises if they prove to be undercapitalized. So enforcement mechanism to make sure the capitalization requirements were met. Unfortunately, they've now been in conservatorship for 6 years, and instead of recapitalizing them, we're using them to fund other budgetary priorities. The Third Amendment was put in place in 2011 or 12. All profits swept out of the agency, so we're now taxing 28 million mortgage payors for the privilege of funding the federal deficit. This is crazy. So the question is, am I right? Did HERA give us the tools to reform the system and to do what Jim just talked about, which is disaggregating some of these functions and avoid the kind of games playing that the agencies did before with their implied government guarantee? And I think it's all there. We can do it. But for the final step, which is actually turning the guarantee from its current backstop through the Treasury Department's preferred stock purchase agreements into real reinsurance. But everything else that Corker-Warner, Crapo-Johnson, that consensus that formed in the center of the Congress, everything else that consensus sought to achieve can be done administratively. And we could start tomorrow if we had the political will to do so. So here I've just laid out a schematic of the Johnson-Crapo-Corker-Warner framework, which is we have a new Federal Mortgage Insurance Corporation which provides the ultimate catastrophic backstop. It collects fees, unlike we are doing today, to build a reserve fund to protect taxpayers against a call on that catastrophic insurance. Crapo-Johnson, Corker-Warner contemplate, but for a small loophole, that Fannie and Freddie are liquidated, brand new players come magically, like Athena springing from the head of Zeus. Magically, new players going to come with $188 billion of private capital to fill the void created by Fannie and Freddie's liquidation. But we have a division between the public guarantee and private first loss capital. For a time, we got all caught up in an eddy that somehow the capital markets were going to provide $500 billion worth of first loss capital with a 10% first loss requirement. Ultimately, I think many of you in the room prevailed upon the good people on the Hill to realize there wasn't $500 billion worth of first loss capital that was ready to show up tomorrow to play this role. And so we've moved to kind of, funnily enough, an insurance model. I think that's what Fannie and Freddie are, insurers. So we've now got insurers playing the first loss role in the Crapo-Johnson system, but again, we're hoping new ones come rather than the old ones that we already have. On the right side is a replica of that system, but using Fannie and Freddie, or at least the assets of Fannie and Freddie, and using the current Treasury Department preferred stock purchase agreement, which was entered into under the authority of HERA with the budgetary commitment of HERA. And what you see is Fannie and Freddie stay in conservatorship, but they become shells. They're just shells, just a vehicle by which to convey reinsurance. The Treasury Department's preferred stock purchase agreements remain in place supporting those shells, but the shells spin off their guarantee businesses. And I think sensibly we should separate multifamily from single family. So we have 4 new entities, 4 private insurers. The privatization process actually brings in first loss capital. It's called equity capital. We can still do these risk and loss sharing transactions, but the best loss capital of all is equity capital. We can go get that from the private markets and the privatization of these 2 entities. And the prudential regulator, the FHFA, can actually make sure that there is competition, that the new entities that Crapo-Johnson, Corker-Warner contemplated might come, they can actually create regulatory incentives for them to come, perhaps placing higher capital requirements on the spun-off businesses, which will have enormous market share, so as to open the field for new players to come in and buy reinsurance. But at the end of the day, We have a privatized system providing first loss capital with equity and potentially risk loss sharing agreements, buying reinsurance from Fannie Mae and Freddie Mac, who are remaining conservatorship, and paying fees for that reinsurance to reimburse the Treasury Department for their backstop today. So I think all this is doable, legally, financially, without market disruption over the next couple of years. And then the question is, okay, we've got the Treasury Department sitting there with a preferred stock purchase agreement, in effect underwriting, conveying the full faith and credit of the United States government through the shells of Fannie and Freddie. That needs to be collapsed and create the Johnson-Crapo model. But until the Congress is prepared to do it, everything else can be done. And the system can be better capitalized, remain stable in the transition so that we don't have a radical interruption of mortgage credit when we wipe out Fannie and Freddie and hope for other players to show up. We can actually do this in a sensible way, just as Herrick gave us the power to do.
We're going to get back to Jim on that one. This is good. Julia, it's great to see you, and I'm glad to have you on this panel and to talk a little bit about the consumer and shelter and kind of what housing's about and what we have to be thoughtful of.
Well, thanks so much for having me on this panel, Faith, and to Urban and CoreLogic for including me in this session. And so I'm going to talk about totally different things than everybody else on the panel has talked about because, it's interesting. You come in here, and in the morning we talk about things that have to do with people who need housing. That could be a song.
People who need people.
And then, we get to this panel and we're talking about mezzanine risk. I mean, no offense to Jim, but for most people, mezzanine risk is like falling off the balcony in a hotel during a wedding or something. So
I hope that someone tweeted that.
Right. I think one of the biggest problems we had during the whole legislative conversation was it sounded like a bunch of Wall Street people talking about an asset. It could have been gold. It could have been pork bellies. It could have been anything. Having appropriate, affordable shelter is a basic building block for any economic success or growth that any individual or country will ever have. Shelter is a basic human need, and if you don't have enough of it, or if people can't afford it, you have a lot bigger problems than whether we're doing HERA or Johnson-Crapo or anything else. So I think it's, especially since we're at a moment now where, politically speaking, we have now confirmed that that our Congress is not in the grips of the grown-ups, and we are not going to get anything done there in the immediate future. Let's really focus on what we can do now for people. We are going to need to figure out a way to get more people into home ownership. I think if there's anything we took away from the slides this morning, it's that we're not going to continue any reasonable level of economic growth if we don't do something to help families manage their budgets, which, not just be at the mercy of ever-increasing rents every year, to build some wealth, to have some stability, to be able to live in higher opportunity neighborhoods, to be able to access the kind of education, healthcare, and other supports that families need to be successful. And we have a system available to us where we can try to do things about that. And, I want to say in supporting efforts to increase home ownership, there's not only is there nothing wrong with renting, but I will say I grew up in single-family rental, and, I'm here, I'm fine. But my parents didn't have any money, and when they got to the point where they needed assisted living or whether they didn't have a house to trade in for that, their Social Security didn't even cover their rent payments. So I want to put a little reality on what people may be facing, when it comes to the importance of home ownership. So I'm going to just talk for a few minutes about Fannie and Freddie, and maybe just for fun, I'll talk a tiny bit about FHA, even though that wasn't in the title of the panel. So Fannie and Freddie were rescued by the taxpayer after getting into a period of financial instability that was not entirely of their own making, but in which they participated in a variety of ways due to a variety of incentives that we have touched on in this panel already. But the fact is, and again, we're living in a world where corporations are people, so you'll excuse me, the way I think about this, but the American taxpayer rescued Fannie and Freddie from death. I think it is important for Fannie and Freddie to do something for the American people. And since FHFA is in charge of Fannie and Freddie right now, a lot of responsibility falls on the conservator regulator. It is absolutely imperative for FHFA to figure out how to get lending happening out there. I absolutely commend efforts to work on the reps and warrants. I will note, and it was very evident in the panels today, that lenders and investors have a lot of reasons they're staying out of the market, and it's a little bit of a whack-a-mole situation. You solve reps and warrants, and they're going to complain to you about DOJ settlements. You solve DOJ settlements, I can assure you something else will come up. But it is very, very important to figure out how to get lenders lending again. FHFA has a lot of control over that and needs to move faster on everything they're doing. You know that regulators are the opposite of dog years. Instead of 7 years happening in one, it sort of takes 7 years to do something that might take 1 year in other parts of the world. We have to move very quickly to solve the problem of lenders not lending in the box that Fannie and Freddie have set out at this point, which isn't totally the problem. FHFA needs to be very serious about its housing goals. Lou Ranieri explained very succinctly how the housing goals did not, in fact, cause the crisis. I like his terminology, urban legend, because that's really what it's become. I feel like I should put something on Snopes so people can look up that it's not really true. It is important for Fannie and Freddie to be doing what they did successfully in the 90s, which is reaching out with targeted programs, partnering with nonprofits and other mission-oriented entities on the ground, providing investment for CDFIs, and otherwise living up to the mission that is in their charters, the charters that still govern what they are supposed to be doing, that they should be serving all geographies and all populations at all times. FHFA has still not come out with their duty to serve regulation that was created by the Democratic Congress in HERA. And that is another opportunity to address some of these marginal markets that really could use some help. Affordable housing preservation, we talked before about how incredibly important that is right now for the rental market. Manufactured housing, which is a critical opportunity for affordable housing for many people, but is rife with consumer abuse and, right now is in about as much trouble as it's ever been in. Rural housing, there are many people who don't have many options if they live out in rural areas and don't have many outlets to go to. It is imperative for Fannie and Freddie to start capitalizing the Housing Trust Fund and the Capital Magnet Fund. And that needs to be done immediately, now, and quickly, because that is, in fact, the mechanism that Congress created to deal with the very low-income people who are never going to be able to be served just by, letting the market do its thing, the way Sean mentioned before. Fannie and Freddie on the servicing side of things, in terms of helping people stay in their housing rather than have a foreclosure if there is a reasonable way to avoid that foreclosure, Fannie and Freddie have come a long way in the last few years and have made a lot of strides on that. There is more that needs to be done. I do still support including principal reduction as a tool where it's appropriate, but even more important is making sure that people do have the opportunity to stay in their home where they can, because that's going to be the best solution for any family rather than falling out of home ownership and having to wait some years to get back in. It's better for communities, and really I think it's better for the whole market. And the last thing I'm going to say, because I know I'm going on for a while, is I think it's very important for both FHFA and FHA, both of whom are engaged now in trying to dispose of non-performing loans in bulk. And all of us can completely understand why, after a loan has been sitting at, banks that we could name for many, many years and nothing's happening to it, that, getting it out of there is a good idea. And everybody wants to get these things. They want to pay off their claims or they want to get it out of the portfolio. Good idea, but this is the biggest opportunity that we have in front of us now to help homeowners and stabilize communities. We've lost a lot of opportunities by our very slow response on getting servicing right, and of course by all the predatory lending that the regulators didn't do anything about for the years leading up to the crisis. So now is the time to make sure that to the extent we are disposing of these non-performing loans, that those loans go out with requirements, that they be handled in a way that prioritizes keeping homeowners in homes, prioritizes stabilizing neighborhoods, and is not just another windfall for the private equity and other investors who are in this space. Again, single-family rental is important. I'm glad there are folks in this space. If we didn't have investors coming into the market, we wouldn't have put the floor under the market in certain places. But it is an incredible opportunity for these agencies disposing of these loans to make sure that they are handled right the first time, quickly, the way they never were in the previous 6 years. The last thing, I will just offer an unsolicited opinion on this week's brouhaha about LTVs, QRM and the going from 95 to 97. And the point has already been made by Lou and others, which is, first of all, and Urban did a great piece on the swing between 5 and 3 not being particularly relevant. But somehow in all of these articles, I never read about the fact that if you have a Fannie and Freddie loan, you do have private mortgage insurance. FHA has very rightly moved to shore up the requirements for the PMI companies. And if we get to a point where we can believe in those companies, then you do actually have a much different picture on the LTV front. And I will stop now. Sorry for the rant, but
excellent.
Somebody had to say it.
Somebody had to say it.
That was excellent. Well, there's going to be a lot of questions, I think, for this group. There's so much we covered in this panel. One question I have for this group is, this morning we talked a little bit about how can we still be in conservatorship after all these years? What does it really mean to the taxpayers to have the GSEs under conservatorship? And why isn't there more urgency if it's true that if one of them, for good reason, through a cycle, comes back and has a draw from the Treasury, there'll be emergency legislation that would be a mess? Do any of you have any thoughts on that? And how can we, as a group interested in housing being stable and secure, do a better job on the Hill on this one to create that
I can take
urgency?
a stab at it. I mean, my sense is that understandably folks are risk averse in a world in which they see legislators mucking around, to Jim, I don't think he used the word mucking around, but he might as well, to channel Jim, mucking around in a space that is highly complicated and that, in a sense, defines a structure on which so many people depend for the biggest asset they'll ever own. And so I think people have had a lot of anxiety about turning the keys over for reforming something as complicated as that to Congress. There was more, I think, receptiveness to it right after the crisis, when I think people were more acutely aware of the shortcomings of the system and were willing to take, maybe in a better position to take a bit of a leap of faith that that it was worth taking a chance that we could lay out reform that would be better than what we just come through. But I think the flip side of that is the longer we go with a market that doesn't require a draw, even if it's a market as constrained and underperforming as a current one, the more comfortable folks get with the status quo, the more risk averse they'll be with dramatic reform, and the harder legislative reform would be. And to my mind, it's one of the reasons why administrative reform is quite important, because I still think that we can get a lot done that will, one, make the system that we have today more stable over time, but two, will make legislation easier over time, because it'll make the distance we've got to cover between the world in which we're doing the legislating and the world to which we want to get through legislation much smaller. One of the things that Jim has rightly pointed out in criticizing a lot of the Johnson-Crapo process is earlier iterations of the legislation really had us going from the current market into a very different, complicated market without an obvious roadmap of how we're going to get from A to B. I think the better we are about laying out what the transition should look and feel like, even if it's done administratively, the more comfort the market will have in pushing for reform, getting behind reform, and the less risky giving the pen over to legislators to craft a new system is going to be, because we will have laid out much of the roadmap and begun to move down the path towards the system that hopefully they'll build out for us.
Let me just, so right now we're running the largest insurance program in the world in the conservatorship, without any capital, without any reserves. It's fiscally irresponsible. So it seems to me that at a minimum, putting aside all the investor lawsuit stuff and where this goes, the government as conservator over these entities should not be writing $4.5 trillion worth of mortgage insurance without a reserve or without capital in the entities that are issuing those guarantees. So the Third Amendment should just be turned off. The government's got $212 billion back on the $189 billion it put in. It's already gotten its money back. We can debate what incremental profit it should get if and when there's a privatization of these things. But in the meantime, while we're having that debate on what an appropriate return on taxpayer investment is for the enormous support they gave to these two entities, in the meantime, while we're running the largest insurance program in the world, we should have capital and reserves. And as you said, this will also make it easier to contemplate reform, because the reform will actually have been implemented that HERA intended the conservatorships to create, which is to recapitalize the system. And so we can get closer to that $188 billion than we are today, which is zero.
One of the things, if I just really quickly to add to that, just as something that's worth, to the degree you guys are interested in this turn in the conversation, worth looking into, is there is at least an open debate about how much flexibility we've got to do what Jim would like to do in reversing the Third Amendment. We don't need to get into it now. It's a mind-numbing debate, but it's important because the way in which the government is now backstopping the enterprises is through, frankly, a contract reached between the Treasury and FHFA, standing in the shoes of the GSEs, and that contract provides, or at least attempts to provide, some limitations in how both parties can act, and it has built into it some limitations on what you could do to change the agreement. And so some of us believe that that hems us in a little bit in how we can turn the Capitol building spigot back on. And all I do is, without getting into that debate, is lay that out there as a flag that's worth noting. If it were just as easy as turning the spigot back on and filling back up the buffer so that Freddie doesn't have to run back to Congress as soon as it would otherwise, then it would be harder to debate against doing it.
But in an interesting way, though, the recent decision out of the court with jurisdiction over the lawsuit, one of the lawsuits, just basically said you guys have, that the administration, both at the FHFA and at the Treasury Department, have absolute discretion, immune from judicial review. So the notion that two contracting parties cannot amend the contract to achieve the legislative purpose that Harris set out for them, a conservative to achieve, strikes me as a little defensive.
So
I want to get back to let me get back to because I think the reason why there isn't an uproar is that there isn't really a problem right now, right? So we have a conservator that's acted, very responsibly. Some people could say they wanted more of one thing or more of another. They should have been conserving more assets, or they should have been doing more affordable housing and helping people more. But we have two organizations that continue to function and provide financing to a large number of Americans. Second is that the biggest complaint about them was that the private gain at public expense is gone because there's no more shareholders, other than the people who are suing, who are trying to get private gain again from the money the Treasury's put up. But we don't have private shareholders. We don't have executives making outrageous amounts of money by using a government guarantee to do that. And then even from the capital standpoint, these entities never had any capital anyway, right? So it was just their capital was practically fictitious. The new, you have the deferred taxes. The idea that deferred taxes, which aren't worth something if you're losing money, count as your capital. I can't even begin to understand how that works, right? That when you need capital, that's when we take $100 billion of capital away from you. It's anyway. So we haven't really changed the situation that much, and it's working. So it would be nice to move to a system that's more stable over the long run, because I don't think conservatorship is a long-run stable situation. The entities in conservatorship are not going to be as creative with doing many of the things that you're talking about, because they only have to serve sort of communities. They only do what they're told to do. But there's really no rush, but it would be good to complete the process.
Yes.
But if there's a draw, that'll change.
And I think with that, I'm going to open it up, because we have about 7 minutes left. Keith Bickman. Be careful when you know everyone in there.
Thanks to the panel for your thoughts. Really appreciate it. Keith Bickle, Bank of America. Question for you. We have two major non-legislative projects that are moving forward that will involve some form of transition for the GSEs. One's a common securitization platform. One is the proposed single security. One is about process, right, in back office. That's the platform. One is about psychology, right? So you have to dealing with the investors. How do you involve, to Jim's point about trying to get as close to the legislation, close to reality, right, to narrow the gap? How do you avoid going through a transition to single security, let's assume it occurs, and then not having to do it again with some form of legislative vehicle that comes out?
My assumption is, and it's just an assumption, and there's certainly risk that this doesn't turn out to be the case, but to the degree, say if we have 3 years of time to do things administratively. So let's say in that period we move to a single security. Let's say in that period we built out enough of the platform so that it's beginning to cover at least some of the functions that ultimately it's supposed to cover. Let's say that we're doing enough risk sharing that you're seeing on a significant number of pools a lot of first loss risk being pushed out in the market. My strong assumption is that Congress leverages that. If it's going to land on a system that's at all comparable, it's going to leverage as much of that as it can in building out the new system. There is certainly the chance that in their infinite wisdom they decide to create a whole new mousetrap that does roughly the same thing. But I think there will be enough of a natural constituency of all those who in this room have been running up to the hill over Johnson Crapo, who will run up to the hill, especially those who actually have to act in this market like you guys, will go up to the hill and say, look, you guys are building a car engine. We have just overhauled the carburetor here finally, and look, it's shiny new and it's working. For God's sakes, don't build another carburetor. My sense is there'll be enough of the natural push from within industry and elsewhere that the pieces that we've developed administratively that work and that seem like viable pieces of the car engine in the next system will in fact be transferred over. God help us if we're that irrational as a body politic that will actually build another carburetor once we've gone to the trouble of overhauling this one. There's absolutely that risk, but my sense is the probability that we know what we're going to get in transition and we control the outcome of what Congress is going to do goes way up to the degree we can go ahead and fix what we can administratively. Does that answer your question, sort of?
Other questions?
Yeah.
Other questions?
There's one on this.
Oh, sure.
Yeah, Jared Seaberg with Guggenheim Securities. Just a quick question. We had an election yesterday. We elected a whole bunch of conservatives who are now coming to Capitol Hill. I thought it was interesting the panel talks about futures that involve Fannie and Freddie when we seem to have elected people who perhaps don't share that vision. Are there other approaches to housing finance reform that you think could advance that don't involve these two enterprises being part of it?
Well, look, you have one in the House, the PATH Act, which calls for a 5-year wind down of both enterprises, and frankly, sort of legislates a path that the former acting director was running the conservatorships towards. I think as I think Gene and Representative Lazio spoke earlier this morning, there just isn't a majority support for that on the even after this election in either chamber. So it's a purist piece of legislation. The Wall Street Journal, I'm sure, editorial board would be applauding it and did applaud it, but I think it has no hope of passage. Yeah, I think you could. Look, Ginny is performing the role of FIMIC in the Crapo-Johnson system, but again, the conservative majority, if it is a majority now, is going to have to get itself a lot more comfortable with the government guarantee, a well-structured government guarantee. And I, applaud Jim and the administration's efforts to kind of move the debate around how to protect taxpayers on a guarantee, making it explicit. But I think the one thing that really was under-discussed in the legislation is we talk about a catastrophic guarantee and liquidity support. It's there for the 2008s. But, what you heard Lou and other panelists talking about earlier is there's also in good times too, 35% of the market since the 80s, since the development of securitization markets, has been provided by Ginnie, Fannie, Freddie, and the FHA. So, is there really private capital there to take on all $11 trillion of housing finance risk? We haven't seen that. And so the sort of under-discussed issue is, in good times, what's the footprint of the government going to look like? I think we're trying to sell people on the idea this is a catastrophic guarantee. It'll only show up in 2008 circumstances when the long tail comes home to roost. But in fact, we've had a very stable, successful housing finance system in the United States that had a footprint either through guaranteed banks or through guaranteed Ginnie Mae and impliedly guaranteed Fannie and Freddies that even in good times had 35% share of the market.
So we had one urban legend, which is Fannie and Freddie caused the crisis. The other urban legend was that we could have a $5 trillion MBS market without a government guarantee. And, so you can try and move down that path. I think it's unlikely to succeed. And the closer you got to it, the more it would be clear that path, the path won't succeed.
To parrot that,
parrot that?
Sorry, that was actually totally unintentional. I need to change my name. So I think to answer it very cleanly, I don't think there's any prospect of legislation passing along the lines of the PATH Act. I mean, it gets vetoed when it gets into the White House. Like, it's just not going to happen. We may see bills flying around that do that, but they have signaled at that point that they're not actually trying to pass legislation if we see a regurgitation of that model again in a way that doesn't have, to Gene's point, some backdoor whispering that, don't worry, this is not what we're going to demand at the end of the day. On the other hand, I think if we do legislation in the near term, for political reasons, I don't think it will be labeled quite like Jim's graph. I think it may have the function. What the administration was trying to do, much to some folks' chagrin, was do a lot of the functionalities that you saw in Jim's graph, at least through a transition period, that would disaggregate functions and push certain stuff into the private market, hold certain stuff back into the public sphere, kind of like Jim's mousetrap did. But for political reasons, it couldn't quite be labeled that. It had to be a little different than the way his nomenclature worked. And my sense is, for the same reason, if you wind up with legislation in the near term, it can't look quite like that. I'm not saying we shouldn't transitionally, through administrative steps, move in a direction that looks and feels like that, but to the degree Congress gets involved at this point, my sense is that is unlikely to happen as the PATH Act is, for similar reasons.
You know, I think it's important to note that today 50% of the market are the GSEs. 2002, 50% of the market was the GSEs. Difference being balance sheets about 25%, and the remaining 25% today is FHA, VA, USDA, rural. That's supplanted the private label securities that were in the mid-teens at that time. So it does beg the question, is there really any incentive for private capital to come back in any other form other than a balance sheet or the government-type programs? Because it's hard to compete with that liquidity in the market.
Yeah, but it's also hard to compete with entities that have no capital and no return on capital, right? So the GFEs have got to reflect a return on capital to let private parties back.
I think our time is up. I apologize. But this was a great panel. Thank you, everyone, and I'm sure you can catch them after. Thank you. Thank you. Thank you. As always.
So I'd like to welcome you all to the last panel on single-family financing. Just a quick reminder, there is a survey for you to fill out before you leave. Please, you can do it during the concluding remarks. You don't have to do it during this panel, but I just wanted to remind you the survey was there. We have an absolutely incredible panel for this last session. So just sort of going down the line, Mark Hansen, who's the SVP at the Freddie Mac Division of Strategic Initiatives. Ed DeMarco, who's now a senior fellow at the Milken Institute and was acting director of the FHFA from September 2009 through January of 2014. Mike Fratantoni, who's the chief economist and SVP at the Mortgage Bankers Association. Rohit Gupta, who's the president and CEO of Genworth, and Bill Emerson, who's the CEO of Quicken Loans. So I want to thank this absolutely incredible panel for being here today. This should be a really good session. I'd like to start it out by first asking some questions on the Common Securitization Platform and the Common Security, and then moving to some of FHFA's recent initiatives. So why don't we start with the Common Securitization Platform? And Ed, you were the one who first introduced the Common Securitization Platform. What were you thinking? Were you thinking more about the current situation or the post-conservatorship world?
So thank you, Lori, and thanks for having me here. It's been a terrific conference today. So the concept of the Common Securitization Platform we introduced into the public space in a publication of the Conservatorship Strategic Plan in February 2012. And what we were looking at in doing that was really the answer is both. We were looking at the current and the situation of Fannie and Freddie, but we were most decidedly looking to the future. And I think anyone goes back and reads what we wrote about this in that strategic plan, it was decidedly about preparing for the future. And to give that just a bit of backdrop, when Fannie Mae and Freddie Mac were put into conservatorship in 2008, it was made clear at that point that motivator for the conservatorship, the reason this needed to happen is while these companies had failed, this business model of the GSE had failed, that the United States would be without a functioning secondary mortgage market in the absence of the continued operation of Fannie Mae and Freddie Mac. So we needed an infrastructure to connect global investors to local lenders that are making mortgage loans. And so the Fannie and Freddie operating in conservatorship kept that connection going. But thinking about the future, one of the things we looked at FHFA was whether the existing infrastructure at either Fannie and or Freddie in conservatorship was strong enough, robust enough, and so forth to provide that sort of infrastructure for the future. And what I wrote in that 2012 strategic plan is that our conclusion was no, and that this was going to require a substantial investment to build an infrastructure for the future, one that used modern technology and open infrastructure that could allow for competitive participation in securitization going forward. And so because they were in conservatorship and this investment, this substantial investment was going to be essentially being funded by the U.S. taxpayer, made sense to make this investment just once, not twice. And so we came up with this idea of developing the securitization platform, begin this process now in conservatorship, so that while the legislative process was taking its course, this multi-year effort could get underway with the good expertise that existed at Fannie and Freddie to get this done, but also to build it with an eye to the future and to have the input of market participants, because this really was part of the bridge from a conservatorship world to the post-conservatorship world. And we wanted this securitization platform to be able to function, to be able to serve the investors and other market participants of the future. So we got working on it, and I would just like to say one thing. I mean, we did this we clearly had our eyes open with regard to what the political and policy process in Washington was thinking and saying. And with regard to this was not driven to any one piece of legislation, but in fact was always meant to be elastic and comfortably fit with any known model of housing finance reform legislation that was out there. And in fact, I would say that all of the leading reform bills for housing finance legislation, each one of them, in fact, incorporates this common securitization platform as being a component part of this post-conservatorship world. And I credit the work that's been going on to get this developed that Mark and others have been involved in.
And thank you. And so Mark, let's move to you. I guess there's been a slight shift of emphasis in terms of the current securitization platform, more towards serving current Fannie and Freddie. What are the highest current priorities of the CSP, and what are the largest obstacles to completion? Why is it going to be a multi-year effort and not a single-year effort?
Well, there are a lot of answers to that, but enormity of scale is one of them. I think the complexity of, Fannie and Freddie from the outside world look like they do the same things, but we never worked together over the years. So we developed manufacturing processes that were different. The platform that Ed gave kind of vision and purpose and potential to was a great idea. The reality now under Director Watt is how do we make that all come about? And so it's at least 3 projects. One is to build a new manufacturing plant where you can turn loans into securities. A second and a third are how do you integrate Fannie and Freddie's legacy systems into them? And those second and third steps are probably the toughest tasks in all of this. We have pipes that work, but they're old. No one would ever accuse them of being modern or flexible. And so what we have to make sure, and part of this grand design, is that we can combine the legacy securities, the nearly $4.5 trillion, with the new securities that we'll begin producing at some point, and that they can all run through the same pipes. So every month you have payments coming through, disclosure going back, all sorts of rules and validation and all sorts of things that give certainty to the marketplace. And that's what makes it so hard at the end of the day.
Thanks very much. Let's actually move on to the common security. Mark, can you describe the thinking that went into the common security? And also, can you talk a little bit about the transition that you're anticipating?
Right. So, again, I think Director DeMarco started the platform with the notion of it being a common, perhaps a utility or something to be determined for the marketplace. And perhaps further, a common security could evolve from that platform. I think where Director Watt picked up on that was to push the security up closer to the current state. And in doing so, as his view is focused more on the current, he thought that there would be benefit to borrowers, taxpayers, and largely the competition in the marketplace. So I think it's been mentioned in some of the earlier sessions that Freddie securities traded historically at a higher price than Fannie. As a result, Freddie doesn't charge as high of G fee. It subsidizes that G fee. So the benefit to taxpayers would be if we could combine these markets and come to a consistent price between the two, that Freddie could charge its full guarantee fees. Those would flow through to the Third Amendment, which would be swept into taxpayers and the benefit of the federal deficit. So that was one dimension. The notion of liquidity benefiting borrowers, I think, is universal, that these big liquid markets attract buyers that seek liquidity, and that drives up the price for the security. The higher the price, the lower the yield. That translates to a lower borrower cost if their loans contribute to this TBA market. And then finally, the barriers to entry, I think, are at least a couple. There's the obvious Fannie-Freddie competition. If we fund at the same place, we can be a more viable competitor to Fannie. But I think, and this perhaps as part of the longer-term vision, that the TBA market within conventional space was Fannie's and Freddie's alone for a long period of time. If there were to be a third or fourth or fifth entrant into that market, they wouldn't enjoy any liquidity, which would mean that their cost of financing would be much greater. And so by creating a facility where you could have multiple guarantors, Fannie, Freddie, plus others, and day one, those new entrants could finance at the same rate, created all the legislative options that Director DeMarco just described, that others could come in, that we could open the doors. So when you put the two together, I think what you have is an ability for others to share the plumbing of Fannie and Freddie, and second, others to share the financing of Fannie and Freddie through the securitization process. Did I answer your question?
Yes, you did a very good job of answering the first part. Then let's talk a little bit about the transition.
So how does it work, right?
How does the transition
that sounds
work? Great
in this room, but you go
Yes.
to New York and they're not so sure.
Right.
So from a market standpoint, what you have are legacy Fannies, legacy Freddies that trade separately. There are a few things that distinguish them, but mostly they pay on different dates. You also now are talking about a third security, if you will, that would be as of a given date, we'll be producing Fannie and Freddie a similarly named security with a lot of common characteristics, but we still have separate guides as are envisioned. So the goal, to kind of work backward, is to take those four markets, the old and the new, the Fannies and the Freddies, and try to get them to trade as one in the marketplace. And by doing so, you take components and create a $4.5 trillion single TBA market. That has all the liquidity benefits and the current trappings of the TBA market. But as you know, in New York and from an investor's perspective, we call these all TBA markets kind of the same, and that the loans are fungible, but they are expert at distinguishing one from the other in many dimensions. So the tallest task in this whole equation is to get the market to see securities coming from different guarantors through different seller-servicer guides under some kind of common alignment to trade as one in all of this. And so what we're hearing back in a lot of the early feedback is we need you to maintain alignment somehow. And that's an effort that FHFA and others are taking on right now to make sure that Fannies and Freddies, although not identical, are close enough to satisfy the variance that TBA allows in this marketplace. Second, they want to make sure that the credit quality is common. We've talked a little bit in some of these more policy level, how do you keep the credit quality of Fannie and Freddie the same when the capital is being swept all the time? And so that's another issue that's at this next leg of the single security conversation we need to address. How do you see those two as the same if they come from different issuers? And then there are issues about transitioning from one to the other. But ideally, what New York will see is the opportunity in the single security. We certainly have heard it from lenders, we've heard it from policymakers, we've heard it from a lot of third parties. But the true test at the end of the day is, will investors see the opportunity in a smooth transition from what they have to what we're describing, and that we can enjoy this combined liquidity of the two.
Let me ask you just one follow-up question on the market's reaction, and that is it generally been positive so far? And I know the investor reaction is more mixed. Are there certain characterizations of those who are for it and those who are against it? And then is there any general summary on the dealers' and lenders' reaction? And then we'll get to Bill specifically and ask him his reaction.
Well, it's probably unfair to characterize by institutional type, but give me a little latitude that way.
Okay, please overgeneralize.
Okay. Borrowers like lower rates, right? The simple equation is greater liquidity translates to lower rates. So let's move through the process. Lenders want competition between Fannie and Freddie. By putting Fannie and Freddie at the same financing via this common market, they get a greater competitive balance between the guarantors that are buying their loans. I think that servicers want certainty about what this is all about. And so, as we did last year with the servicing alignment efforts, by bringing Fannie and Freddie together through this common security and platform, you start to make life a little easier for servicers because they have one more common approach to how they service the business, not these bespoke rules and guides. When you get to Fannie and Freddie, we're competitors. Even in conservatorship, we're competing. But what a lot of this work has done over the last 5 or 6 years is start to bring us together for more common goals that are outlined by FHFA. So we're doing that work. When you start getting to dealers and investors will always profess that they want liquidity. But at times they make their alpha otherwise. Dealers like to have many markets, but they don't want to be caught short. In the last couple of years, we've imposed additional fines on dealers that have to fail on trades. And that was viewed as good for the markets, but it puts them in a more precarious position. So if they are short on a Freddie trade and can turn a Fannie into a Freddie, and that bails them out of a short, it's a good thing. But some investors on the other side of that trade were the recipient of those fails and those charges. And so I think where we see the greatest resistance to some of this is, from an investor's perspective, I like the way the market works now. I know how to outperform in this market. I'm not sure I know how to outperform in this deeper, more liquid market. And I'm not sure if the benefits that I accrue today will persist into the future. They don't want to say that they're against liquidity because they need liquidity. They just also like the benefit of being able to use their size at times in the marketplace. And that might not be as great of advantage going forward if we make this market deeper.
Thank you very much. Bill, could you comment from the lender's point of view on the common securitization platform and the common security? How do you think it's going to affect you as a lender?
Sure. First of all, thanks for having me.
Lender.
It's great to be here. Second of all, as I listened to the earlier panel with Lou Ranieri, and we talked about a lot of the same things, I just figured my answer when you ask me questions from now will just be Lou Ranieri. We talked about it already. So I just say Lou Ranieri. But I think, listen, liquidity is a big thing for any lender, right? The ability to have liquidity and what that means, as we've heard talked about now, the difference between Fannie and Freddie and the way that Freddie has to compete with Fannie to subsidize that is not ideal, I think, for any system. And I think the more you can have competition that's based between Fannie and Freddie on things like customer service and delivering things to the end consumer, I think the system wins. Somebody asked me that question, what would Fannie and Freddie compete on? What does any other business compete on, right? The acquisition of clients, customer service, the care of that. So I think, the single security is something that makes sense for the industry. As it relates to the common securitization platform, I think about this in the broader sense of the industry and the fact that it's good for the transition and the things that we talked about, the previous panel and Jim and the group talked about, for transition steps to whatever the future world looks like. Because the current world isn't sustainable necessarily for all the reasons that were talked about earlier. So the technology piece of that, going into that, makes total sense to us as a company who believes in technology and the connectivity of technology. I'm also keenly aware of the fact that the plugging in the pipes, as you would say, between Fannie and Freddie and getting that plugged in there does have some challenges to it. But I think at the end of the day, the system itself is much more objective, and it pulls a piece of the process out of Fannie and Freddie and makes it something that it should be, which is objective, and lets Fannie and Freddie actually go focus on other technology things that they should be doing around their internal models.
Mike, you, at the NBA, you've been very supportive of the single security. Did Mark and Bill do an adequate job of capturing your views, or is there something you'd like to add?
I think they did a great job. It's just more competition today between Fannie and Freddie and enabling greater competition in the future from additional entrants. It really removes barriers to the potential for that in the future, but they did a great job answering the question.
And Ed, when this first came up, you were more ambivalent about the single security, a huge fan of the common securitization platform, conceived it, originated it, but more ambivalent about the single security. Why, and have your views changed on that?
Well, ambivalent's an interesting word, Lori. I mean, I think when when we put out the strategic plan and we talked about the platform, right in that discussion, we talked about how this, could, logically lead to a single security, and we termed it an intermediate term outcome, knowing that there was a lot of front-end work with the with developing the platform.
I revised the word ambivalent to lower priority.
There you go. It's a question of ordering, right? I mean, each of these in their own way are big transition steps, maybe seismic, some might say. But I mean, just take what Bill said a minute ago, right? I mean, you got to plug in these pipes. The market wants to know about doing these kind of transitions, and that there's the proper preparation and ordering for this. And so, how does this tie into actually rolling securities off the platform? How do we deal with the legacy issues? Mark described that very well. It wasn't a question of, no, I don't think we got to do this. It is a question of where's the sort of, optimal point to fit that sort of transition into the work stream. And the other thing I would say is it's just me personally, right, is that I really felt on this issue the need to maintain a substantial degree of humility about just how this would work, what the risks were involved, and what the market's reactions and expectations were going to be. This kind of change in security structure had been done before. It didn't work out the way it had been anticipated. The Fed's mortgage purchases and the effect that was having on the spread between Fannie and Freddie didn't necessarily work out the way some people had anticipated. So to me, this was simply a note of caution. Let's make sure we step carefully through this. But this is all part of a logical progression, and I think the work that's being done on it and what the current FHFA is doing to develop it, it makes sense to be moving in this direction.
Lori, can I just make one more point there? And this is something that we've raised in our comments. Anybody who's been in a large institution involved in a large technology project knows that these things sometimes can go well beyond their initial time frame and budget. And just a note of caution there, right? I mean, there's always a worry that this could be an excuse for slow walking a move to a single security if you put the platform in front of it. And so that's just something that we've just sort of been vocal. We're going to keep an eye on that, but we wouldn't want it to be an excuse to not get to this thing that we really think is a remedy to the competition problem.
Thank you very much. I'd like to switch gears now and move on to mortgage insurance and the new private mortgage insurance eligibility requirements as put forth by FHFA. And we're lucky enough to have Rohit here. There continues to be a great deal of skepticism in the industry about the mortgage insurers, which is sort of understandable given what happened during the crisis. The PMIERs are intended to address that concern by instilling more confidence in the system, presumably without going overboard. Do you think that it hit the sweet spot, or are there changes? And then why don't we start there, and then we'll move on.
All right. Thanks for the opportunity, Laurie. Great conference. And given the events last night, I think this is such a good conference to talk about all these topics. Let me provide some context on mortgage insurance before I answer the question on PMIERs. If you think about private mortgage insurance industry, and this is a very good data point based on what Andrew just talked about in the last panel, that we would need $200 billion of capital to basically back that $5 trillion of debt. Through this cycle, since GSEs went into conservatorship, mortgage insurance industry against GSE claims have paid $43 billion in actual claims. Those are claims that are right in front of taxpayers. Those are claims that were actually collected by GSEs, and GSEs didn't have to draw that money down from Treasury. That point often gets lost. So wanted to remind the audience of that. Second thing, the industry has raised $9 billion of additional capital in the last few years. So that continues to replenish the industry in terms of new capital funded by private sector, whether IPOs or private capital. Third thing I would say is the industry worked the way it was intended to work. In 2007, when mortgage insurance industry went into this downturn, there were 7 MI companies. During this downturn, 3 MI companies went into runoff. Along the same time, 3 new MI companies came in to make sure that there was credit access and availability in the marketplace, and those 3 new MI companies were completely funded by private capital. No bailouts, no external money, paid $43 billion, and basically continued along the path. Now, There were shortfalls in terms of claims paid through the cycle, but one of the runoff companies is still paying at 100 cents on the dollar. The second MI company is paying 67 cents on the dollar in terms of their runoff claims. And in the Mark Zandi recent paper, I think he refers to the total expected claims against GSC claims from MI industry is at 95%. For an industry that actually went through a 70-year flood, I think that's a pretty good performance through the cycle. Now, that being said, the industry has learned its own lessons and has started implementing its own learnings. On October 1st, all MI companies rolled out a new master policy that was worked in conjunction with customers as well as primarily GSCs and FHFA. And that new master policy is a contract between us, our servicer partners, and policyholders, GSCs, that gives extreme clarity on how we will pay claims in the future. So if there were any concerns about clarity of policies, it's finally there in the document. Second thing, the industry has been working with state regulators to also update NAIC Model Act. And NAIC Model Act is something that regulates all the insurance companies because we are state regulated. So we are in the process of doing that. And many of the MI companies have engaged with Oliver Wyman to basically build a ground-up risk-sensitive model to kind of control our own capital, almost a regulatory standard. Third thing, transitioning to your question on PMIERs, we think that PMIERs could be a strong foundation to a risk-sensitive counter-cyclical capital model. The way our industry works, in good times, we accumulate capital. We keep building our capital as home prices are going up. As we reach a cycle, we use that capital to pay claims. And through that cycle, we deplete our capital by paying claims, but making our policyholders whole. And then as the cycle recovers, we build up our capital again. So that's kind of the construct we think about from a PMI perspective. We think that PMI is a great, or GSE eligibility guidelines for mortgage insurance companies is a very strong initiative. We commend FHFA and GSEs for undertaking that initiative. But we do think that there has to be a balance between how bulletproof the standard has to be and cost of credit access. If we plan capital for a 200-year flood or a 500-year event, cost of homeowners' access to that same loan will go up. So there has to be some balance in terms of how tight the criteria is and the impact of that criteria on access and affordability. I'll give you a simple example. In the currently drafted PMIERs, if we were in first quarter of 2012, and at that point, home prices have declined 33% already, the current PMIER criteria would point towards an additional 20% decline for a cumulative decline of 46% from the starting point. Trying to plan capital for 46% of home price decline would be much worse than the most recent downturn that we came through. And if we start planning that capital, every aspect of mortgage finance, we just have to be very conscious of cost of homeownership and where that leads. So we've provided some refinements, some comments and recommendations back to GSEs and FHFA and look forward to engaging, but we are supportive of the effort. Sorry about the long answer.
No, that was a great answer. And I actually wanted to highlight one thing is that I cannot think of another industry that's banded together the way the MIs did to sort of say, okay, here are the changes we need to make, even before the regulator said, oh, gee, we'd really like you to make these changes. I mean, you guys sort of banded together, and there's not another industry that I can think of going through the crisis that really did that. So let me actually follow up your very nice discussion with one more question, and that is, how do you see the interaction between mortgage insurance premiums and G fees, and sort of where should, how do you see that interaction? And then, Mike, I'm going to ask you the same question.
Yeah. So from our perspective, mortgage insurance premiums and G fees are two separate discussions. I think PMIERs or GSE eligibility criteria for mortgage insurance companies should be finalized. When that gets finalized, MI companies get to decide what premiums should we be charging to consumers in order to generate the right return for our investors, because we are publicly owned companies largely. And at the same time, G fees, our philosophy is that G fees should be transparent. G fees should give appropriate credit for mortgage insurance coverage. And then in addition to G fees, even in previous discussions, we've lost context of this loan level price adjustments. We think that loan level price adjustments could be something that needs to be looked at, and it actually opens up access to lower credit and higher LTVs. Some of the things that we've talked about in terms of minorities and low down payment borrowers, we actually have hindrances in that area. So providing transparency and actually setting those fees at the right level will actually get to a good result.
I'm going to agree with Rohit completely on the transparency point. Might disagree slightly. I think these two have to be thought about together, and our focus really is on end price to the consumer. The point about LLPA is exactly the right place to focus. So if you look at what's happened to G fees post-crisis, they went from about 20 basis points to over 60 basis points today. Then on top of that, you have LLPAs, which range from 25 basis points for a low-risk borrower to 3 points for a higher-risk borrower. That's fine if they're not already paying for covering that risk somewhere else. And we think there really is an aspect where the consumer is getting charged twice there because in the pricing models, the cash flows that are going to come from the MIs are effectively haircut because there's concerns about ability and willingness of the MIs to honor those claims. I think between PMIERs and the new master policies, we are answering those questions. So if you have stronger counterparties, I think there's room for LLPAs to come down. So whether as a result of these changes, private mortgage insurance premiums are higher, we're a little bit indifferent as long as the LLPAs are lower and the end price to the consumer is little changed. I think then you'll have more private capital in the market, which is where everybody wants to go. But I think you do have to be sensitive, given the weakness in terms of particularly the first-time homebuyer market right now, of just raising prices there. I think shifting who's bearing the risk and what form of capital, private capital instead of taxpayer capital, I think makes a lot of sense.
Bill, what is it going to take for lenders to view MIs with more comfort, or are they totally comfortable at this point? I mean, as a lender, how do you view the MI industry?
So, comfort's a relative term, right?
Yes, that's another word I wish I had subbed out.
At the end of the day, I think time will show us how this is going to all work. I think the moves that are being made with the PMIERs process are very important because if you step back for a second and you look at, and we'll talk about rep and warrant, I think, a little bit later, but if you take a look at how things were operating in 2007, 2008, 2009, an MI rescission was a shield for the GSEs to issue an automatic repurchase. So there was a connectivity there that just made the industry very, very nervous. And the fact that while, and all due respect to my colleague in front here, Rohit, claims were paid, but a lot of claims weren't paid. And so when you think about insurance and you're someone that's in the seat of having that insurance pulled from you, it doesn't feel very good. So I think the right steps are being taken with this process to put MI on a firm footing. It's important to have it in the industry. The private capital nature of that is very, very important. And let's face it, if you're going to lend above 80 LTV to Fannie and Freddie, it's a necessary evil. There's nothing you can do about it, right? So how do we work together to make sure that some of the things that happened in the past don't happen on a go-forward basis, that we're all kind of playing on the same playing field, understanding what the rules of the game are, and so that we can participate in that game and make sure that we're doing it the right way. And so I think I'm optimistic that I think it's just a matter of time, but I do believe that trust will build itself back up, not only based off of the master policy process, the PMIERs, the entire process there, but how the MIs execute on their business model.
And one last question on the MI business. How do you see it developing? Are we going to see more activity in non-agency space, perhaps some pool insurance, or how do you see your business developing?
Yeah, so I think two different answers. First answer is Lurinary. I think he gave a long list of answers why PLS market in the short term might not revive itself. So when it comes to pool insurance being applied to PLS loans, which MI industry historically has participated in, I think in the short duration that is something that's almost not there, non-existent. Most of the PLS being done right now is way below 80 LTV, and I'm not sure if it needs that much credit enhancement. I think just a connection between PMIERs and pool insurance, one of the current flaws in GSE eligibility guidelines is for deeper coverage or for low LTV loans, it actually does not lower the amount of capital. Right. So the lowest amount of capital you can get is an 85 LTV loan. So if an MI company was insuring a 65 LTV loan, we will be holding capital for an 85 LTV loan, and thus we will be uncompetitive. So that's something that is a recommendation we've given back to the FHFA and the GSEs. So as that changes, we can definitely see the model evolving. We need to recover our ratings as an industry, and the industry is working towards it. But the topic of housing reform is something that still plays through when we talk about ratings and how that credit enhancement will be rated in future.
Okay, great. Let me actually move on to talk about back-end risk sharing, and then we'll go to front-end risk sharing. Ed, when you put out the first strategic plan in 2012, risk-sharing transactions were an important part of your effort to bring private capital back into the market. How close is what evolved to what you initially conceived of? I mean, this has been like a huge success, and it's just...
Yeah, no, in fact, I think it has evolved, largely as we had hoped. What we had hoped was to make a declarative statement that this was the path we were on, that we wanted to initiate a process of identifying multiple executions paths for transferring some portion of the mortgage credit risk away from Fannie and Freddie in conservatorship to private capital. And we knew that initially, starting out, whenever you do something like this, it's everybody's learning. You got to write docs for the first time, legal agreements for the first time, market's uncertain, Fannie, Freddie, FHFA are uncertain. But the idea was we wanted to commit that we were going to try multiple things, and we wanted to get this process started. The very first transactions, in fact, took up to a year to do, in part because of all this development work. But we knew once we got it done that the market, the pricing of this would improve, and that they would start to build some excitement and interest in this in the market. That was certainly our hope, and I think that that's what we're seeing. I'm pleased, generally with the continued evolution of this and the commitment to it. We have seen multiple types of risk transfer taken place. It started as these, so-called mezzanine deals. In part, that was to deal with a regulatory issue that was outside of our collective control. But we also were hoping for other things. Reinsurance transactions, those have taken place. The very interesting transaction just in the last week or two Fannie Mae did with J.P. Morgan Chase. Now it's not a Connecticut Avenue security. I guess it's a Madison Avenue security. You can decide whether that's a good or change. But I mean, that is first dollar loss that's in that transaction. The amount of risk that is being transferred continues to grow. And I think that the path that FHFA and Fannie and Freddie are on to continue to develop this is really quite exciting.
And Mark, in your view, is Freddie happy with, or how successful do you view the back-end risk-sharing transaction?
No different than Director DeMarco. I think we'll likely see a doubling of what's out there for next year's goal, provided the markets are as receptive as they've been. We just completed a kind of an Asia tour, and there's very strong interest, I think, throughout the globe, just like we saw with pass-throughs. The financing went far beyond the U.S. shores during its best days. The TBA market was a source of liquidity and comfort for large foreign central banks. And not that foreign central banks will be players in this, but there are sovereign wealth funds and other yield seekers globally that I think have already demonstrated strong interest in the product. So, we happen to be in a cycle where there's not a lot of competing product right now. Private label market is down, so time will tell what the capacity for this market is. But I can't imagine us being off to a better start than we are so far.
Great, thank you. Mike, the MBA has been out with a front-end risk-sharing proposal. Can you describe it? And also, why are you guys so supportive of it? Why are you pushing it when the back-end transactions have already been so successful?
Yeah, well, I mean, I think two of us, maybe three other people in this room think there's nothing better than sitting down on a Friday night and reading a prospectus. It really is neat stuff, some of the structured finance that's getting done. But I think for a typical mortgage banker, they're not seeing the benefit of it, right? It's not transparent to them how increasing these back-end transactions are going to result in lower prices, more credit availability to them. And so our view was, let's do something that, rather than sending all the risk into the GSEs and asking them to take the execution risk of then trying to lay some of that risk off through structured transactions, as useful and as practical as they are, let's de-risk the pools of loans before they get to the GSEs. And do that in stages that look, in a lot of ways, like Johnson Crapo or a lot of other proposals for the market going forward. And you look to who could take on first loss credit risk at a deeper level than they are today, sort of the natural candidates
And you look to your
are folks in the MI industry. And right now, in terms of taking credit risk in the conforming conventional space, you have, with apologies to Mark, sort of 1.5 competitors, given the single security issue that we talked about, that they can't really compete in a full-throated way the way the MI industry can, with 7 full competitors and really the risk of additional entrants coming in if they don't do a good job. Operationally, what we're talking about is, as Bill said, right now, anything above 80 LTV needs MI if it goes to the GSEs. What if we just drop that to 60, right? And any lender could do that today, sort of flip of a switch. It's operationally would be very simple. It's a question of pricing both that deeper MI and then how much of a reduction in G-fee or LLPAs would Fannie and Freddie provide for an MI taking that deeper credit risk. Obviously, it's reliant upon what we talked about earlier of ability, willingness to pay, master policies, PMIERs in place, so we need stronger counterparties for this to work. We always talked about it as optionality on the part of the lender, right? The lender would have 2 executions, either pay the full freight G-fee and LLPA or bring deeper cover in and get a lower G-fee and combination. This would be another dimension along which Fannie and Freddie could compete. We think it makes a lot of sense. Obviously, a lot of reluctance from both GSEs to pursue this. There's a mention of the JPM deal this week is sort of a flavor of this, where JPM really is taking on the first loss risk and then doing sort of a copy of the Connecticut Avenue structure after that point. It really, and if you look at the analysis on it, it's not clear that someone who doesn't have a large investment bank can do that kind of a structure. So for the other 7,000 mortgage lenders out there, we need something that works, and we think this MI model is probably the easiest way to do it. And again, it could happen as soon as we get PMIERs in place, we think, provided the law structure is correct.
So you stressed that you need changes in the PMIERs to make this work, but aside from that, can you guys handle front-end risk sharing? Is this a business you want to do? And moreover, you're probably going to have to raise additional capital if you do it in any size. Do you have any reaction there?
Yeah, I think, Laurie, I will agree with Mike. We are ready to do it. We have done it in the past. In fact, if you're familiar with the mortgage insurance company rate card, there is deeper coverage that exists right now. So from an operational execution perspective, this would be an easy thing for MI industry to do. From a capitalization perspective, if you've noticed multiples on mortgage insurance industries in the marketplace, I think those multiples dictate that there's availability of capital from equity markets, from debt markets, and third, very importantly, from reinsurance markets. So I don't think there's shortage of capital if there was an interest to do these transactions. I do think that there could be some fundamental principles on how we design, whether we go with front-end or back-end risk share. Availability to a broad set of lenders could be a big one. Do we basically do risk share transactions that are only done by the biggest corporations, bigger banks or bigger mortgage banks, or is it something that can be executed by everybody? Second thing could be sustainability. Yes, we are really glad that these risk share transactions are being really successful. Mortgage insurance industry has actually participated in some of the back-end transactions. But would you be able to execute a back-end risk share transaction in June of 2007 after you've already offered that note rate to the consumer? And if you cannot, where does that risk go? Then we are back with the taxpayers. Whereas, to Mike's point, if you're doing a front-end risk share, obviously implying here that MI company capital and master policies are in place. If you're doing a front-end risk share, the loan does not get originated unless the risk is already shared. So those could be fundamental principles. Third and fourth would be reducing consumer cost. A borrower has already paid the note rate. If GSEs get a benefit in executing a back-end structure, the consumer doesn't get any cost back. If you did a front-end risk sharing and it was cheaper than you expected, the borrower saves money.
Yeah, point of sale pricing, basically.
Last thing I would say is taking the risk off GSEs, or off taxpayers in the long term. And again, the difference between back-end and front-end would be you always have to hold risk to do a back-end risk transaction, because there's always that risk that you originated the loans, and while you were waiting for those 60 days, the market changed. All of us have been through June, July of 2007. The rates on May versus the rates in July were different. And during that time, if you're left with that risk, it's better for that risk to be on private balance sheets versus taxpayer balance sheets.
Bill, do you have anything to add to front-end risk sharing? Is this something that you're looking forward to as an additional alternative?
Yeah, listen, I think as a business person, you always want optionality, and I think what was described here was very eloquently put. And I think the reality is, as you think about it from an originator, what is the best option for your consumer, your client? How can you give them the best deal, the best price, and pass that through? And if you can do that through other front-end risk share opportunities, why wouldn't you have that on the table? And to Rhodes' point about the back-end piece and the potential risk of a catastrophic event, the industry should have the optionality of both front and back-end.
Right. Ed, how much risk sharing should the GSEs do, and how should we think about it? Should it be 100%? Should it be whatever they can do economically? How do you think about it?
Given where we are right now, Lori, I think that my thought about it is that you just continually, gradually, relentlessly expand this in two dimensions. One is with regard to the scope of the flow of new business that is subject to risk share. So look at the very first transactions. We were looking at all below 80 LTV loans. We've made progress going above 80 since, but I think that the idea is you continually look to expand it across the flow of new business. And then the other dimension is you continually look to deepen the amount of risk transfer that actually takes place. And I'm not sure you're going to get to, let's not sort of set an end target so much. I mean, if there's a belief that the catastrophic risk is always going to remain sort of with Fannie and Freddie in conservatorship, there's still, substantial, more that can be done in terms of deepening the amount of sort of normal risk that gets transferred. To me, I think the idea is that you just continually develop this in each of these two dimensions, and you look for these various approaches to doing that to see is there a best path for certain types of loans one way or another. And the more you do this, you also are getting feedback from the marketplace about how it's pricing credit risk.
Okay, thank you. At this point, let me move to administrative actions on reps and warrants and on the servicing side that can be taken to open the credit box. So, Bill, why don't we start with you? The FHFA seems to be making a lot of progress with the lenders on reps and warrants. What do you think is left to address there?
Well, I mean, I think first of all, we need to see what actually comes out, right? I mean, Director Watt made an announcement that these shifts and changes are going to take place. So I think let's see what that looks like first before we can really decide what needs to be done more along those lines. I mean, the basic premise of this, and we've talked about this for 4 or 5 years, is the fact that you don't have a clear rule of the road. And what that does is it causes people to not want to lend. And so I applaud what FHFA is doing on this front. And for some reason, it gets distorted into the fact that they're giving something up. They're not giving anything up. They're simply putting in place rules that are clear so that everyone understands how to operationalize that and how to execute in the marketplace. And when that happens, it allows you to be able to make good business decisions about what you want the credit box to look like. So I think that's a very, very important concept that we have to keep in mind here as we go through this process. I would tell you that I think Fannie and Freddie have done a very good job of beefing up their front-end QC, QA process. And while these things will come out and may give better clarity and may ultimately release some overlays, I think that's what everybody's trying to get done here, right, from an access to credit perspective. Out of the gate, with Fannie and Freddie doing more upfront QC, the industry may feel the same pain that they were feeling before, only now it'll be on a client who is performing and looks otherwise good. So, I don't think it's just a fallacy that they're giving something up. It's about getting clarity around what's going on, and it's about clarity of risk transfer and making sure that you know what you're doing as an originator. If you make a mistake and it's a mistake that's material and relevant to the performance of that loan, be held accountable for it. But the standard that perfection is going to exist in the origination process it's just flat out fallacy. It's flat out wrong. There's not a human being in the world that's perfect. There's not a process in the world that's perfect. So there needs to be a good balance and understanding, and I think that's the progress that's being made. And once we see how that, what actually gets rolled out, then we can answer the question what still needs to be done. I can tell you that, some of the things that are being talked about is, as opposed to repurchase, is there an alternative remedy to repurchase? And as opposed to Fannie and Freddie being for lack of a better term, judge, jury, and executioner. Is there a independent dispute resolution that can come out of this that makes every side feel good about the process that we're going through? So I'm encouraged to the fact that that's happening. I'm encouraged what that means for access to credit, and I think they're the right steps to be taken, because at the end of the day, this really will, done right, help the consumer and help some of the folks that we've been talking about here who are having a hard time getting access to credit.
Mike, anything to add to that?
I think that's right. I think if you can get to a place where lenders feel they're just being held accountable for originating loans that meet the terms of Fannie and Freddie's credit requirements, and not just being held liable for any loan that goes bad, right? And then an excuse looked for after the fact to see if you can pin that loss on a lender. That's where you want to be. And so just the rep and warrant issue can get lenders going to the full extent of the credit box that Fannie and Freddie make available. The 97 LTV, I think, as was discussed earlier, is a nice potential incremental add to the credit box. I think it's probably more of a messaging aspect of this than anything else.
Rohit, lenders have long complained about similar uncertainty over the MI's enforcement of their rescission rights. I think you guys have taken some steps to address that already. Can you describe what you've done?
Sure. And Bill talked about this earlier. So the criticism on MI industry has been willingness to pay. And I think first thing I talked about earlier was our new master policy. So our new master policy also already provides very explicit contracts and policies and procedures on how we will pay our claims, how we will investigate files, at what point we will investigate files. So actually puts a lot of responsibility on us. Second thing, mortgage insurance industry actually provides underwriting free of cost to our lenders on every loan that the lenders want to get underwritten by any MI company. So this is not true just for Genworth. Every MI company offers free underwriting. When you actually get a loan underwritten by an MI company, your chances of rescission probably go down by 80%, 80 to 90%, because in a delegated world, an MI company has never looked at the loan except for the data. And last thing is, if you look at rescission history, most of rescissions were in high-risk loans, like they were in NEGAM loans, they were in Alt-A-NINA loans, in subprime loans, where there was a big difference in expectation of an MI company on what I got in a loan and expectation of an originator on what I originated. As QM has basically kind of introduced a wall between the market and that credit class or collateral class, by default, the number of rescissions and even possibility of rescissions has gone down significantly.
Let me actually, so I think rep and warrant is one set of issues that's necessary to open the credit box. The second set of issues is that it's just gotten so expensive to service delinquent loans. So, Bill, your thoughts on compensatory damages and other servicing issues and what could be done to lower the cost of servicing with an eye toward opening the credit box?
So I think that's a great question. I mean, the compensatory fee conversation is taking place with FHFA. We're trying to make some progress as an industry on that, because if you think about the current foreclosure process, you take a look at some of the states that foreclosure timelines are extremely long. It's a little bit out of control of the servicer's hands, and yet 70 to 80% of the loans that fall into a bucket along those lines automatically have compensatory fees, and there's not much the servicer can do about that. So there needs to be a recalibration there, and I think that conversation is taking place. Servicing, in a broader topic is something that, frankly, I worry about, because if you take a look at the servicing landscape today, it's shifting and changing. The impact of Basel III and what larger financial institutions may or may not choose to do with servicing could have an impact on originations. If there's not a place for servicing to go, it's absolutely going to impact the front-end origination process. So, that's a bigger picture topic that I think we need to start thinking about as an industry. There's more non-bank servicers than there have ever been. And folks want to talk about getting things off their balance sheet and selling loans, but somebody's got to service those loans. So I think there's a bigger topic that's got to be talked about there. As it relates to delinquent loans, they're very expensive to service, and I don't have the answer on what we do around that. I can tell you that as I think about FHA, for instance, I mean, the loss mit process associated with FHA is not clear. It causes very large concerns for FHA servicers. FHA is not even something we've talked about yet here today, but that is a concern as well. So I think overall servicing, it's become very It's become cumbersome to do so. It's been very, very heavily regulated, rightfully so, given what's taken place. And so I just think we have to start thinking about the landscape of that and the impact that that could have on originations.
And then, Mike, your group has done some work on this. How big a deal do you think it is?
Just 3 numbers to throw out there. If you look pre-crisis, the direct cost of service alone was on the order of about $60 per year. That went up above $200 in 2013. Now it's down to about $170. But that direct cost of service does not include certain unreimbursed foreclosure and REO costs. Those have been averaging about $60 per year the last couple of years. So what used to be the full cost of servicing is now effectively going to compensatory fees. It is a big deal.
And Ed, you've long been a proponent of changing the servicing pricing structure as the only possible solution for this.
Right. Yeah, Lori. I mean, it was one of the first sort of areas of changing the model, if you will, that we started working on at FHFA with Fannie and Freddie in conservatorship. I think in retrospect we may be a little bit sort of too far ahead of our time when we did it. At that point, the servicing was still concentrated in 4 big banks, and depending upon which profit center in those banks you were in, you either loved the fact that we were talking about changing servicing comp or you hated it. And in fact, what we've seen as the market is developed and we've seen all these sales, it's almost synthetically creating some of the compensation structures that we were talking about. So as you think about the secondary mortgage market on a go-forward basis, especially one of the permanent effects of this crisis and its aftermath is going to be, and Bill was pointing this out, a pretty rigorous framework for default servicing standards and requirements going forward. I think that we still need to rethink how mortgage servicing is compensated and how we go about in the securitization process, building in a price difference for compensating servicers for performing loans and a different pricing or compensation for non-performing loans, because the compensation on non-performing loans has got to match up with all the expectations and requirements and compliance burden in terms of how we make sure we deal with borrowers that fall behind and give them a chance to stay in their house. But that's expensive, and we've got to have the comp piece has got to match the expectations of what the work is.
Thank you guys very much. I think what Allison just shot me this thing that said wrap up, so why don't I take two audience questions and then we'll move to the conclusion. Any hands? Yes. Sarah?
So given this great group, I sort of wanted the opportunity to go back to the question about single-family risk sharing for a second, regardless of where you put it in the process. How do you think about, let's assume the GSEs are in conservatorship for a while. How do you think about it from a taxpayer protection perspective when one of the consequences of some of the risk-sharing deals may actually be that the cost of capital for the partners is higher than the cost of capital for the GSEs, and so to a certain extent you have to share more of the premium in order to be able to get them to absorb more of the risk. And so you're not giving away in direct proportion to the GSE's risks. And so if we're thinking about having healthy balance sheets to emerge into some new market in the future, you may actually be challenging the GSEs the more you do the risk sharing. If you think about taxpayer exposure, you may be reducing the capital ahead of the taxpayers. Even though we all agree there's lots of value to price discovery and lots of other things from this. Are we willing, does that put any brake on how much risk sharing that we ought to be doing? And if not, what's the reason why not?
Well, my view is we're a long way from having to worry about putting a brake on risk sharing. And in fact, to the extent one sort of feels that, what this, more and more risk sharing does is that, private markets will have to require greater compensation and hence mortgages get more expensive. Let me just tell you the flip side of that coin is that just tells you something about how much continual subsidy is flowing from the American taxpayer, into the mortgage market today. And so if, in fact, there's that big a difference, that's because there's an ongoing, continual, quiet, unobserved subsidy from taxpayers to homeowners. And, in fact, if we want to get to any one of these housing finance models in which we're looking for private capital up front first, even with preserving a catastrophic government guarantee, that private capital is going to allocate a certain amount of equity for single-family mortgage credit risk based upon the underwriting standards that are applied, and the G fee that's got to be priced to pay for that is sufficient to generate a competitive return on equity, for that amount of capital. And I think that, we've actually made a lot of progress over the course of conservatorship with the G fee increases that have taken place. We have been imputing capital, to Fannie and Freddie as we think this through. So that jump today is a much smaller step than it would have been 5 years ago.
Just a couple of thoughts on that. Completely agree that right now all that risk is being borne by the taxpayer. They're being almost first dollar risk because the GSE's retained capital keeps getting whittled down year after year, just according to the terms of the agreement with Treasury. I think part of the discussion going forward, though, is a recognition that if the GSEs are in that first dollar loss position on behalf of the Treasury, the return should be commensurate with that, exactly to Ed's point. If you remove them to more of a catastrophic position, the way we're talking about this upfront deal, then a AAA position doesn't get a equity kind of a yield. They should get a AAA kind of a yield, and return should be priced accordingly. The whole process doesn't work if they don't do that, and that's the nature of a lot of the discussions we're having between industry and the GSEs right now.
Any other questions? Okay. Well,
thank you.
Thank you all very much. This was great. I guess it wouldn't be fair if I asked another 5 questions that I still had on my list. Thank you very much. Thanks. Thank you. That was really appreciated. Great. Thanks. That was terrific. Thanks.
Well, you can't leave yet. Thanks for coming. A little bit of housekeeping. Can you fill out surveys? I think it's great. It gives us a lot of something to work with when you give us feedback. Lori's going to give a closing recap of this, and I hope this is valuable to you because we spend a lot of time thinking about what would be really important to the people in this room. So thanks so much for being here. It's a diverse crowd. It's a great crowd. We've been very excited all day that you're here. We still have people at tables. That's pretty cool, really. So thank you from CoreLogic, and thank you to my colleague Lori Goodman for co-sponsoring, and now we'll hear from Lori.
Well, thank you all very much for being here today. It was a really, really interesting set of talks, and I learned a tremendous amount. So again, thanks for being here, and CoreLogic, thanks very much for co-hosting. Let me just do a quick summary of what were the highlights for me, with apologies to the speakers who brought up points that they wish they were in here but weren't for whatever reason.
My apologies, but let me sort of talk about what I thought the highlights were. So Sarah's discussion with Gene Sperling and Rick Lazio was extremely interesting. Lazio thought the Republicans could end up picking up as much as 9 seats. Sperling pointed out that things can change very rapidly. 2016 is going to be much more difficult for the Republicans. It gives them the responsibility to pass legislation that the president then has to veto, and that may prove to be more difficult than many think. Lazio sort of came back with yes, but the Republicans have a lot more leeway. McConnell was concerned with the right flank, and he now has a larger majority. Boehner is going to be willing to take more risks, and the result is they can get more done. On the tax reform discussion, Gene Sperling mentioned that there's a consensus on the corporate tax, not on the individual tax. That is, there's a consensus that there should be lower corporate tax rates and a minimum tax on foreign earnings. And on the individuals, while there is some consensus that we should have a lower tax rate and less deductions, it's not clear what deductions should be eliminated. And as they both point out, whatever deduction is up for elimination, the lobbyists come out in force. Sperling thinks that you should do corporate tax reform alone. Lazio's point is that you need both, and one in isolation doesn't really help. On housing reform, Sperling pointed out that Johnson-Crapo was very close, and a broad consensus was developed on the government role that you need that catastrophic government guarantee. While the gap is now wider as a result of last night's elections, it's not impossible to close. Lazio thought there was too short of a window to get housing reform, and it's simply not a priority right now, or at least comprehensive housing reform. Moving along to Sam Cater's talk, he made the point that home price growth is decelerating, but low-end prices are up much more than higher-end prices. In the past year, low-end prices were up 10%, and the overall market was up 5.5%. And part of the reason for this is that sales have been more responsive to rising rates than they have in the past. That is, interest rates were up, sort of close to 100 basis points, and certainly sales are more responsive to that than in the past. We're in a very, very weak market from both the supply side and the demand side. Credit demand is weak because incomes are flat. Home prices are relatively high relative to income. 20% of homeowners don't have 10% down, and the credit of those that has been foreclosed on does not recover, he said, ever. And then you've got a weak supply of credit. That is, you've got basically a lot of credit overlays. Credit scores are very high. Credit scores have to be pristine, and DTIs have to be very low for borrowers to get a mortgage. So weak supply, weak demand. On session 1 on demographics, Ellen did a fabulous job monitoring. Rolf made the point that we have very weak household formation, and a lot of that formation is minorities. And moreover, there's a very weak translation of household formation to home ownership. Hispanics are potentially the only bright spot. He also made the point that new renters are going to be greater than new homeowners through 2030. Through 2020, about 65% of new households are going to be renters. And then he also mentioned that there's a huge geographic issue because, you look at national numbers and they may not look so bad in terms of shortages, but a home in Grand Rapids does not meet demand in Houston. Chris Mayer pointed out that 90% of people own at some point in their life, and 86% of the older population now owns homes. However, there have been sharp declines in the home ownership rate of those born between 1950 and 1964. And this is a huge cause for concern because most Americans haven't adequately provided for their retirement. So with Social Security and Medicare, if you own, you can get by, and if you don't, it's a lot more difficult. So you need a way to make home ownership much more stable. Enrique pointed out that the huge geographical changes in the location of Latino families. They're no longer just in southwest cities. There's a far wider geographic distribution. 80% of rural growth is minority, and most of that is Hispanic. And home ownership has a unique cultural importance to Hispanics. On the credit side, there are three unique issues in terms of expansion of home ownership to Latinos. First, multi-generational households with more than two earners. Second, income documentation can be an issue with many individuals having more than one job in irregular schedules. And third, there are multiple sources of down payment, and traditional mortgage underwriting doesn't cope very well with any of those three things. Sarah Gorecki talked about assisting in the renter-to-owner transition, especially given the increasing complexity of the own-to-rent decision. She made the point that counseling has served 1.5 million borrowers last year, and 43% of that for delinquent borrowers, but pre-purchase counseling is increasing a good deal in importance. Moving on to session 2 on rental multifamily housing, David Borzos made the point that since 2000 there are more than 6 million new rental households. The growth in rental rates is much higher than the growth in income. The affordable stock is way lower than it needs to be, and most of that is concentrated in small buildings. And while credit is available for multifamily, it's very limited on the affordability side. He made the point that a lot of these units are substandard, and no one sets out to build C-quality buildings. Chris Tawa talked about some of the FHFA actions, mentioned that the scorecard for 2014, small affordable multifamily units were excluded from the cap. The housing goals comments letters, which were due in recently, set a new goal for Fannie and Freddie to do small multifamily. Freddie has introduced a small multifamily program relatively recently. Both Fannie and Freddie are working more with tax-exempt bonds, and next year on the docket is credit risk transfer of the government piece in the multifamily arena. That is, there's already loss sharing in these deals where the private sector shares with Fannie and Freddie, and then there'd be a further risk transfer which lays off the government risk. Shaker made the point that we're in a rental housing affordability crisis. New construction is very expensive. You can't produce affordable units. Most new rental housing has been single family. He applauded efforts to do more for small, older multifamily, made the point that the low-income tax credit has been effective. It's been responsible for 2 million units. And it's particularly, on the coast, it's particularly in demand, but it's much less available outside, or much less effective outside the East and West Coasts. Sean Dobson made the point that half of renters lived in detached housing, and if he could add one item on his wish list, it would be an institutional funding product for single-family, geographically diverse purchases. He mentioned that it could lower the cost of funds by about 100 basis points, which allows these buyers to pay more for the homes because of this. He also sees a role for REO to rental operators to partner with local governments. David Brickman made the point that it's difficult to get capital to affordable rental housing. You can't get enough supply at the right cost, and he questioned whether it's an income issue or a sufficient ability to build issue because of zoning, etc. So, there was sort of broad consensus on that panel that there wasn't nearly enough capital for affordable multifamily, but the question is how to get it there. The lunchtime conversation with Lou Ranieri and Nick Timros was extremely interesting, and everyone for the rest of the afternoon has been quoting Lou, so maybe we should have just ended the conference there. Lou made the point that the two biggest issues in the mortgage market are, first, a tight credit box due to overlays, certainly relaxing reps and warrant, certainly more clarification on rep and warrant provisions can help, but that still doesn't solve the issue with the SEC, the state attorney generals, the CFPB, etc. And then the second issue is that the millennials are more diverse than predecessor generations with more minority households, and we're not doing a very good job serving this population well. Of the 2000, he pointed out that in the 2013 HMDA data, there was 1.6 million purchase loans and from 1.6 million conventional purchase loans. Very few of those were to African Americans or Hispanics. Opening the credit box is not a return to poor underwriting. Fannie and Freddie have made great improvements in the past few years in terms of automating the underwriting process, which has done a real good job of protecting them while allowing for higher quality underwriting. So appraisals are better, they're more automated, they've got a common portal. And he also made the point numerous times that affordable housing goals were not responsible for the 2007 situation. So in short, opening the credit box is not a return to poor underwriting, it's a return to rational underwriting. While Lou hasn't given up on GSE reform, the major route forward is administrative. The FHFA can lower the loan limits tomorrow if they wanted to. However, the PLS market is not in a place to take that risk at this point in time. The common securitization platform is important. The need is immediate, and you need to stop the subsidy Freddie is providing. It's irrational. In the PLS market, the key is to rebuild trust. Maybe we get $10 billion in new issuance this year, which last year there was less than $20 billion. In 2001, it was a number like $200 billion. The market can't handle $50 billion in volume at this point. The question came up in terms of fiduciary responsibility to investors. Should the trustees have that responsibility? Lou's answer was the bondholders need more disclosure. They need information. They need a better voice. And either directly or indirectly, they need someone representing their interests. It does not have to be the trustee. That's a problem that SVIG, the Structured Finance Industry Group, is focusing on. Session 3 on the current state of the GSEs was really, really interesting. And let me actually do a really poor job of summarizing Andy Davidson, Jim Parrott, and Jim Milstein's comments in one unified piece. They all agreed GSE legislative reform is unlikely, so we need to work through administrative channels. So with that as the basic prescription, they each had slightly different remedies. So Andy's proposal is we transform the present system into one that gets where we want to go, putting private capital first. And we do this by dividing the GSE functions into their component parts: the loan insurance business, the bond insurance business, securitization services, the retained portfolio, the multifamily business. We assign a capital charge to each function. We look at the profitability of each business to inform future legislation. Jim Parrott says, clearly, we've learned that we're not going to get GSE reform, legislative reform in the meantime. So what we want to do is continue to move along present channels. We want to disaggregate the functions with moving ahead with the current securitization platform and the single security. We want to do more risk sharing. But we want to sort of move along current channels to the extent possible. And we also need to learn from what failed last time, and especially on the small lender access and affordable housing crop subsidization issues. Jim Milstein sort of takes a more radical approach. HERA gives us all the tools we need to get most of the way to GSE reform as laid out in Johnson-Crapo. And so what he would do is essentially spin off, basically sell off the private insurance, have Fannie and Freddie sell off the private insurance business, and then those insurers would buy reinsurance from Fannie and Freddie. Jim's proposal, which actually does get a lot of the way toward Johnson-Crapo in terms of allowing the government to provide the regulation, the prudential requirements, the market liquidity, and keep the wide availability of the 30-year fixed-rate mortgage, but allow private money to take the first loss. So it does actually keep the elements of Johnson-Crapo, but it does require changes in the preferred stock purchase agreement to complete. And Jim Parrott and Jim Milstein disagreed sharply on how possible that was. Julia Gordon made the point that home ownership is important. It was the taxpayers that rescued Fannie and Freddie in 2008, and they should be doing something for the American public. And her her wish list includes the following: first, the duty to serve language is not finalized as HERA asked that it should be. That needs to be done. Second, the affordable housing goals are important. Third, the Affordable Housing Trust Fund and the Capital Market Magnet Fund should be funded as HERA provided. Fourth, it's important to keep people in their home through principal reduction. And fifth, when disposing of non-performing loans, prioritize to keep people in their homes. So that was the first 3 sessions, all of which were excellent. And then the final session, I did not take very good notes. So let me do that very quickly. The Common Securitization Platform is a multi-year effort. The hardest part is integrating Fannie and Freddie's legacy systems, and that's what takes the time. That is, the old infrastructure on both Fannie and Freddie were deteriorating. That's why Ed DeMarco conceived of the need for the Common Securitization Platform. But when you actually get down to the nuts and bolts of tying together legacy systems, it's extremely difficult and time-consuming, and they're working through those issues. There is general support for the single security and sort of a view that the transition can be handled. But however, before that can be done, you definitely need alignment in terms of prepay speeds, in terms of policies between Fannie and Freddie, and the market is demanding that as well. The mortgage insurance industry has made great progress by itself prior to the P. Myers rules in terms of when it pays claims, in terms of master servicing agreements. The P. Myers rules, that is the private mortgage insurance eligibility requirements, move that along. They are a little bit more draconian than they need to be in certain places, but they're a pretty good set of rules which should further strengthen comfort in the mortgage insurance business. There's general consensus that the back-end risk sharing has been a huge success, and front-end risk sharing, and there's room for front-end risk sharing as proposed by the MBA. Mike Frattantoni gave a very good description of front-end risk sharing, and Rohit Gupta from Genworth made the case that the GSEs can handle this quite comfortably once you get the necessary change in the P. Myers rules, and they've been hugely successful in raising additional capital. There's a general consensus that you need changes, that you need further clarification on reps and warrants to open the credit box, and those actions have been moving along. There's also a consensus that you need to do something on the cost of servicing in order to further open the credit box, but it's not clear what those actions should be. So that's the overall summary of today. Again, thank you all very, very much for coming. On behalf of CoreLogic and Urban Institute, we're looking forward to seeing you next year, and we're also looking forward to seeing you at our Sunset Seminars.